Hello and welcome to Ekcel Academy. In this session, we are going to discuss the subject capital market and securities laws. In this session particularly, we are going to go through the basics of the syllabus, overview of the syllabus, and directly we are going to dive into lesson number 1, that is basics of capital market. If all of you have actually opened your books and seen the material and gone through the syllabus, you already know that this particular subject is divided into two parts. Part A is capital markets, which carries 40 marks, and part B is securities laws, which carry 60 marks. Now, why does the institute want you to first study what is the capital market and then study what are the laws applicable? It is rightly done so by the institute because until and unless you don't understand what is the structure of the market, why a particular market is in existence, what are the functions of this particular market, how does it operate, why is there a need for regulating this particular market, until and unless you don't know these aspects, how will you be able to understand what are the laws that have been framed for this particular market? So the institute wants you to first understand the foundation of the subject by understanding conceptual clarity about the working of the capital market. Once your foundation is clear, you will be in a better position to understand why Securities and Exchange Board of India has created certain rules and regulations, why the authority has passed a particular regulation. Right? So that is why the institute first wants you to understand what are capital markets and then you to understand what are securities laws. Now, before going into lesson number 1, let's quickly understand what is the objective of the syllabus. By reading the objective of the syllabus, you will be able to understand what is the expectation of the institute from the students. You as a student, if you don't know what is the expectation, how will you even be able to fulfill those expectations? So it is important for us to identify why the institute has created the syllabus, why they have included certain chapters, and what are they expecting from students in relation to this particular subject. So let's see with respect to part 1, that is capital market. The institute, that is ICSI, wants you to have the basic understanding about the working of capital market in India. What they want you to have a basic level of understanding about how capital market functions, how it operates. That is all is what they are requiring from you under part 1. So under part 1, we are going to see concepts like what is financial market, classification of financial market, what are the functions of these markets, how do they operate, who are the participants. All those like concepts we are going to study here in part 1, and other basic regulatory framework, certain enactments are there, we are going to cover that under part 1. Moving to part 2, that is securities laws. This is slightly complex when compared to part 1 because institute has certain higher level of expectations in relation to part 2. Why is that? That is because the institute is expecting two things out of you in relation to part B. What is that? They want you to have conceptual understanding of the securities laws. In addition to that, they also want you to have the working knowledge of securities laws. So they are talking about two things, conceptual knowledge and working knowledge. And you can get working knowledge, and the working knowledge expectation is like a professional level expectation. So they don't only want you to have conceptual clarity, but they also want you to be in a position to implement those laws in any given practical scenario. That is called as working knowledge. So how is the institute going to test your working knowledge? They are going to give you something called as a case study type of question. What does that mean? That means that the institute is going to put you in a hypothetical situation, in a practical situation, and they are going to ask you to handle that situation. They are going to put you in the shoes of a company secretary and say that whether this particular thing is possible, not possible, justified, not justified, you have to give an outcome. They want to see how you are going to handle a particular situation that is put forth before you. That itself is the working knowledge. So for answering the questions from part B, certain higher level of expectation is there of the institute from the students as such. So you should be very careful while you're studying part B. Now, how are we going to go ahead with the preparation? The first thing that I would say is focus on the conceptual understanding. If your basic foundation is strong, if your concepts are clear, everything is rightly understood, only then you will be in a position to answer any hypothetical situation or practical question that is going to be put forth by the institute. If your foundation itself is not clear, if your concepts are not clear, if there is any tricky question or complicated question, you will not be in a position to answer. So first, don't focus on the working knowledge. You focus on attaining the conceptual clarity. Automatically, when your concepts are clear, you know the provisions of law, you will be able to answer any kind of given practical question. So always focus on having your strong foundation by having 100% clarity about the concepts that you are going to study. So what are they expecting out of you of part B? Conceptual understanding as well as working knowledge in relation to the securities laws which are governing the entities which are listed on the stock exchanges. That means the securities laws is applicable only and only to the listed companies, the companies listed on the stock exchange. More details of this I will tell once we go forward. As of now, this much understanding is sufficient. I've just put the index of your chapters. Part 1 has 7 chapters for 40 marks and part B has 11 chapters for 60 marks. Now, let's directly dive into lesson number 1, that is basics of a capital market. One thing that I like to say before starting any new chapter, you should have the curiosity, you should ask yourself about what new am I going to learn in this particular chapter. You should have the structure of the chapter ready in front of you. For that, you should create your own index. What are the new things? What are the headings? What are the subheadings? What am I going to cover in this particular chapter? That basic understanding you should have right at the beginning before you start the chapter. Like if you create this index, if you have this in mind, it will also help you in prepare the chapter. It will help you prepare deadlines for completing that particular chapter as well. So what I have done is I have divided this entire chapter into 3 parts. First part is the financial market classification. What are we going to see here? We are going to see that financial market is a wider terminology. Like for example, CS course is a course that you take up to qualify as a company secretary. Within that course, you have CSEET, you have CS executive program, CS professional program. All these 3 exams put together, you have a CS course. That is a wider terminology for multiple levels of courses, multiple level of exams that they are including. Similarly, financial market is a wider terminology. Within the financial market, we have various segments and classifications which form a part of the wider market, that is financial market. That is what we are going to focus on in part 1 of this chapter. Under part 2 of this chapter, we are going to identify financial market participants. What do you mean by participants? For any transaction, for any purchase, in market what happens? Buying and selling, trading take place. So whenever you are buying and selling commodities, you need a party who is the buyer, you need a party who is a seller, you need a subject matter. That could be vegetable, that could be chocolates, that could be property, that could be shares, anything. So there are parties that are going to be required for completing a transaction in the market, and we are going to identify who are the important parties or participants in the financial market. And thirdly, we are going to focus on the financial market instruments. What are instruments? Instruments are nothing but the subject matter. If you're going to purchase vegetable, vegetable is the subject matter. If you're going to buy a house, house is the subject matter. In that instrument will become the title deed. If you're going to buy a share, the equity share itself is the instrument. So whatever is being transacted, whatever is being bought and sold itself is going to be instrument. And in the financial market, we have various instruments like equity share, debentures, bonds, units of mutual fund, right? Indian depository receipts. All these are instruments which we are going to cover in our syllabus. So this is the basics that we have divided the entire first chapter into 3 parts, where first we are going to focus on the financial market classification. Second, we are going to concentrate on the participants in the market, and third, we are going to move ahead and see what are the various instruments. Now, when I'm giving this division, it is important for you to understand that part 1 is theory, part 2 is theory. That means they can ask you case study type of questions as well, but predominantly it is not numerical in nature, whereas financial market instruments is that important element of the chapter where, in addition to theoretical questions, that is both direct questions as well as case study type of questions, they are also going to ask you numerical questions. They are also going to ask you numerical questions. Mathematical questions are going to be involved in this particular part. So now, with that basics, let's just begin with identifying what is financial market, what is the classification of financial market. Now, before going into the actual theoretical part, let's quickly take an explanation and then read through what has been provided in the material. Now, just imagine that there is one person, okay? This one person is salaried and he is getting a very good income every month. He is a person of luxurious life. So after fulfilling all his basic necessities, after fulfilling all his luxuries, after having the kind of lifestyle that he requires, even after that, he is able to have some extra funds at the end of the month. He has surplus money in his hands and this money becomes his savings. So he has surplus money with him over and above the money that is required for him for his necessities and luxuries. Even after that, he has a lump sum money which he is having as his savings or surplus money. On the other hand, there are people like companies, like government organizations or government entities who have some projects in hand. For example, the government wants to construct roads. They want to construct highways. National Highway Authority of India wants money to construct the highways. Company, it wants to expand its operation. It already has 2 factories. It wants to set 3 more factories in different locations. So what happens to undertake the projects that they are planning? They are in need of capital. They are in need of money. They are in need of funds to actually implement the projects that they have in their mind or the thing that they want to implement over a given duration of time. So what is their situation? There is one person who has surplus money. Like this, various other investors will be there throughout the country who have money, who have savings, who want the scope. They have extra funds of money. They don't know what to do with those funds. On the other hand, you have companies and government organizations who are actually in need of some funds, are in need of capital. Now, when you know these 2 categories of people are there, can we not solve the problem by merely connecting them with each other? So the people who have extra money can give their money to the companies and the government organizations to implement their project, and they who do not have money can take it from the investors like you and me or various other banks and financial institutions, right? So that is what is the financial market. So what is the financial market? Financial market is a platform where we are facilitating flow of money. From where? From people who have surplus to the people who are in need of the capital. Financial market is a place where we are going to facilitate the flow of money from the person who have surplus to the people who are in need of those funds. This itself is the financial market. Now, next question is, ma'am, why will a person give his money to the company or government organizations? It's not a donation, it is hard-earned money of him as well. So why will he give his money? Obviously, he's not going to give it free of cost. He is going to expect something in return from the companies and the government authorities. He wants to grow his money. He wants growth for his money. He wants his wealth to increase. So when he is giving his money to the companies and government organizations, he says, okay, today I am giving you 10 rupees. After say 6 months, you give me back 30 rupees. So he is not giving it free of cost. He is having some kind of expectations while he is giving the money. That itself is returns. What are the various forms in which the investors can expect returns? One is the dividend. If you're making an investment in equity shares or preference shares, you're going to get some returns in the form of dividend. In case the company is earning profits and declaring dividend, you can get dividend. In case it is a debt instrument like bonds and debentures, you are going to be entitled to fixed rate of dividend interest. So interest is a source of return. Next, you have something called as capital appreciation. That is nothing but increase in the value of your investment, which we are going to see in some time. I'm going to give you detailed explanation of what is capital appreciation. You can get bonus. These are certain ways in which the investors can earn returns by giving their money to the people who are in need of these funds. So this is what happens in the financial market. So what is happening here? There are people who are in need of funds. There are people who have surplus money. The people who are in need of funds are looking for what? They are looking for raising capital. They want to raise money. They want to call people to subscribe to their instruments. They want people to buy their shares or bonds. They want to raise capital. On the other hand, people who have surplus, they are looking for opportunity. What opportunity are they looking for? Opportunity for making investment. And this gap is bridged by the financial market. Let's see. So the financial market dispenses efficient flow of investments and savings in the economy in order to facilitate the growth of funds for producing goods and services. So we are going to put the money into productive use. What does that mean? If I have money, I have surplus money, the investor has surplus money. If he is merely keeping in his bank account, he is going to earn minimal amount of interest on his savings account. He is going to get some interest. Fine. But imagine if that money is handed over to the companies. It is handed over to the government. What is going to happen? They are going to increase their capacity of manufacturing, or the services can be provided to a double extent. They can expand their business. So once the companies are able to put that money into productive use and increase the manufacturing in the country, that will increase the revenue for the company as well. Indirectly, it is also going to help the development of the economy, because we are going to use that money. We are going to channelize that money. We are going to utilize that money for doing something much useful, that is producing goods and services within the country. So that is what they are telling here, that we can channelize the money, we can provide a facility where the money can be channelized, it can be directed from people who have excess to the people who are in need of the money for the purpose of producing some kind of goods and services. But people who have surplus, they are going to invest in securities only with the objective of earning some kind of return on their investment. Nobody is going to give you the money free of cost. They are going to have some kind of expectations. They want some returns on the investment that they are making. It could be anything like dividend, return, bonus, capital appreciation and the like. Next. What are the three major roles or responsibilities or functions as such of a financial market? First one, we have rightly already discussed, that we are going to facilitate transfer of funds between the lenders and the borrowers. What does this mean? This means that we are going to ensure that there is flow of money from the people who have surplus to the people who are in need of those funds. The lenders could be banks, financial institutions, investors, and the borrowers could be business houses, companies, it could be government, right? So we are ensuring that we are transferring the funds from people who have excess to the people who are in need of that money, so that that money can be put into productive use and also help the development of the country as a whole. Second one, it creates securities for investment. What does this mean? This means that we know there is an investor. Let's assume he has 1 lakh rupees excess. This is the capital or this is the surplus that he has. This can be handed over to the company. The money can be transferred to the company. So he is going to make an investment in the company by giving 1 lakh rupees. But in return, don't you think he will require some kind of acknowledgement that the company has actually received some funds? If he's just giving the money without getting anything in return for that money, how will he get to know that he's actually made an investment? What is the proof that he's given the company 1 lakh rupees? So what happens is whenever a person is going to make an investment, he is going to get something in return, that is an acknowledgement. Some kind of proof of investment. That yes, this person is entitled to get so and so money from the company at certain duration. So when, let's assume he's made an investment of 1 lakh rupees and let's assume the value of one share is 10 rupees. So that means the company has to issue this person 10,000 shares. These 10,000 shares itself is the security that is created by the company as a proof of investment. This person holds 10,000 shares in the company. He holds 10,000 securities of the company. That is a proof of investment. At any point in time, you can tell the company, yes, this is the investment that I have made in your organization. So the company is going to create a security whenever a person is going to make an investment. This security will differ. If the company is raising money by the way of equity, they are going to issue equity shares. If the company is going to raise money by the way of a debt instrument being debentures, they are going to issue debentures. If they are going to raise money by the way of debt instrument being bonds, they are going to issue bonds. So the security will change when the objective of the company, the way they are raising funds are going to change. But ultimately, some kind of security has to be created and given to the investor when the company is receiving any kind of funds from the investor. So here we are going to create those securities whenever we are going to invest. I mean, if the investors are making an investment, we have to issue them securities. So the issuer is going to create these securities and hand over those securities to the investors. Lastly, we have efficient trade of these securities. What is trading? Trading simply means buying and selling. Buying and selling. Let's assume in the same example, this person has 10,000 shares. What is their same example? This is the investor. He had 1 lakh rupees. He had invested that and now he has 10,000 shares of that particular company. This person today has surplus of 1 lakh rupees. Let's imagine a situation. He is in some kind of urgency. He has some kind of emergency because of which he needs some kind of finance. So what is he going to think? He is going to think, let me see what all I have, what are the various sources with which I can get cash in hand. He is going to see all his bank balance. After that also, if he is not able to raise money, he is going to first think, what are my liquidatable assets? What are liquidatable assets? Anything that can be quickly converted into cash. Any asset that can be quickly converted into cash in a short duration of time is called as liquidatable asset. And generally all the securities in the financial market are liquidatable. That means you can quickly convert them into cash. But how is that possible? How can we say that the securities are liquidatable or you can easily convert them into cash? So what has happened? This person is in need of money. Today he has 10,000 shares. Earlier he had 1 lakh rupee, he had cash, he converted his cash into shares. Now again he wants to convert this share back into cash. How is this going to take place? Will he go back to the company and say, take back your shares, I don't want it? No, company, once they have made an issue of the shares, they cannot take back the shares until they make a decision of either winding up the company or doing a buyback or reducing the share capital or providing an exit offer. These are all the situations where they can take the shares, but otherwise they are not going to take the shares. So what is this person going to do? Will this person go to different category of people? Do you want the shares? Do you want to see? Is he going to look for buyers? If that is the case, it is not liquidatable. Why will even he make an investment in that instrument where he himself has to go and search and look for buyers to buy the shares that he has bought? That is why we say that we have created a market that is called as the stock exchange. What happens on the stock exchange? Stock exchange is nothing but a market where we are going to deal in securities. So this person can actually go to the stock exchange and sell his shares. In the stock exchange, you have investors throughout the country present. So you don't have to actually go and look for buyers. You don't have to go by yourself personally and talk to people, do you want to buy the shares, do you want to buy the shares? You just place an order that I want to sell these shares. Somewhere around the country, somebody would want to buy, automatically the order is going to be matched and the sale will be completed and you are going to get back the cash. So this facility of buying and selling the shares or the securities is itself called as trade, and one of the most important functions of the financial market is to provide efficient trade of securities. For providing efficient trade of securities, we have the stock exchange, where at any point in time, any investor can place an order for buying or selling of securities over this particular platform. So what are the three primary functions of the financial market? One is to facilitate the transfer of funds or flow of funds from the people who have access to the people who are in need, so that money can be put into productive use. Second one is to create the securities as a proof of investment for the investors. And lastly, if an investor has made an investment, that should be liquidatable in nature, and that is why we should provide them a platform where they can trade in these securities. That is why we have created the stock exchange, where people can place an order of buying and selling the securities on the stock exchange. I hope it is clear. Now, next, let's look at the detailed functions of the financial market. The first most important function, like we have already discussed, is utilization and channelization of funds. We are talking about two important things. We are talking about using the funds and channelizing the funds, that is directing the funds. What does that mean? It means that the investors have extra money. We should put that money into use rather than keeping it idle somewhere. Second one is channelizing. You want to put that money to use, but how can you put that money to use? Only if you channelize it, only if you direct it, only if you help that money flow from them to the people who are in need of that capital. That is nothing but corporates and business organizations. So what are they telling here? It is the function of a financial market to facilitate mobilization and channelization of the savings of the investor into most productive use by giving it to the corporates or companies or manufacturing organizations or the government authorities, so that money can be actually put into productive use for increasing the manufacturing of units, increasing the production capacity, for increasing the services that are being provided, and like reasons. Next, the second function of the financial market is price determination. What is price determination? We know that we have a stock exchange for the purpose of trading of securities, that is nothing but buying and selling of securities. When we are going to do this buying and selling activity, whenever you buy something or whenever you sell something, price has to be determined. At what price is the buyer going to buy? At what price is the seller going to sell? That has to be determined. How are we going to determine what is the price of one security on the stock exchange? That facilitation also is going to be provided by the financial market, because they are going to help us determine the value of one security purely on the basis of demand and supply in the market. Pure concept of economics, what you have studied in standard 12, that is only going to become applicable even here. So what are they saying? They are saying that it is the role or function of the financial market. It helps in determining the price of the securities on the basis of basically the demand and supply in the market. Let's take a quick example. Let's take two examples. First, let's assume there is one product A. Okay, there is a product A. What happens to this product A? They have manufactured 1 lakh units and that is there in their inventory. They have 1 lakh units of this product A. But there are no purchasers. Hardly 100 units are sold in the market. They do not have many buyers for that product, but a lot of production has already been done. What is going to happen to the price of this particular product? It is going to go down because they want to in any way be able to sell the inventory that they have. So if they reduce the price, maybe they might find some buyers. Maybe they think it is expensive, that is why they are not buying. If they reduce the price, maybe there will be buyers for that particular product. So when you have a lot of supply in the market but the demand is not there, there are no buyers, the price is going to fall down. On the other hand, let's assume there is one product, the product is product B and the units available in the market are, let's say, 1000. But actual people who are ready to buy the product, people who are demanding the product, maybe it's some kind of unique product, very rarely available product in the market, and the buyers are 5000. So the demand is more than the supply. Supply is less, supply is limited, only 1000 units are available, but 5000 people want those 1000 units. So they are going to fight to get that product. So they are going to give competitive prices and they are going to increase the price of the commodity. Whoever pays higher is going to get the that particular unit. So whenever the supply is less but the demand is more, the price is automatically going to go up. Here the supply is there but the demand is not there, the price is also not going to increase. So this is the basic concepts of demand and supply. Obviously there is much more depth of knowledge in this with respect to demand and supply, but this is the basics. So on the basis of demand and supply, it is going to impact the price of the securities. The same thing happens even on the stock exchange, where price of the securities is going to be determined on the basis of demand and supply. Let's quickly take example in relation to the securities market itself. All of us know that every quarter end, all the companies have to give out their financial statements. Half yearly also they have to give, even at the end of the close of financial year also they have to declare their financial statements. Let's assume two situations. There is one company which is going to declare profits. Company is going to declare profits. They have declared a very good financial and they know that in the times to come, in the next 2-3 quarters also, that the company is going to perform well. When you know that a company is going to perform well, you know that that company can give you good returns. And wherever there are good returns, you will definitely find investors who want to buy the shares of that particular company. If you know it is a good source of investment, you can definitely earn returns by making an investment in this company. People will want to buy the shares of that particular company. So what is going to happen here? The demand for the shares is going to increase. More and more investors will want to buy the shares of this well-performing company, good performing company, who has promised and shown projections that they can increase their profits to a significant higher level in the coming quarters. So the shareholder investors will want to buy the shares of this particular company, right? On the other hand, so this is the overall picture. Now let's assume there are already certain shareholders who have the shares of this company. Do you think that they will sell the shares? No, even they want to continue to hold the shares. They are not interested in selling. They don't want to sell. They also want to continue to hold. On the other hand, there are other investors who are not currently the shareholders, but they want to become the shareholders. They are wanting to buy the securities. So what is happening here? We have constant number of shares, right? If the company has issued 1 lakh shares, in the market only 1 lakh shares will be available. Out of that 1 lakh shares, these are the shareholders who have 1 lakh shares. Out of this, few people will sell, few people will not sell. So people who are ready to sell. They are going to create the supply in the market. That is, existing shareholders who are ready to sell their shares will determine how much supply is there in the market. On the other hand, demand is going to be created by the investors who want to buy more shares of that particular company. So the shares are constant. When we are telling supply, it is not about how many units are there. The number of shares in the market is going to be fixed, but how many existing shareholders are ready to sell that is the supply, and how many new investors are wanting to buy the shares of that company is the demand. So when your company is performing really well, the existing shareholders do not want to sell it, but more and more investors want to actually buy it. The price of the commodity is definitely going to increase. The price of your shares is going to increase because there is demand and there is limited supply. People are not ready to sell the shares of that particular company. So the price is going to increase. On the other hand, let's assume there is one more company which has reported losses, which has reported that the management is not proper. There are internal disputes within the board of directors, that they are involved in some kind of wrongful or fraudulent activities. In this case, none of the investors will want to buy the shares. They don't want to buy. Why will they invest in a loss-making company when they know that there are no projected returns also? Over a given duration also, the company is not promising anything. Why will investors want to buy the shares? Over and above that, the existing shareholders will also want to sell off their shares. If they sell it today, they can sell it at 100 rupees. Maybe after the company is going to report more losses, the price of the share might fall up to 70 rupees. So instead of making a loss of more, you can just sell it off at 100 and save from further losses of 30 rupees. So even the existing shareholders want to sell off the shares of this particular company. So what is happening? The supply also increases. When I say supply increases, that means the existing shareholders are wanting to sell off, dispose of their investments. On the other hand, the demand is also not there because the other investors are not inclined on buying the shares of that particular company. So when a lot of supply is there in the market, existing shareholders are trying to sell it, the buyers are not inclined in buying, the demand is less, the supply is more, so the price of this particular share is going to fall down. So this is how demand and supply mechanisms work in the market. I have just taken one example of profit and loss, but the price of the securities are determined and fluctuate. They fluctuate on the basis of n number of other factors. I have just taken one basic factor for the purpose of explanation. Right? So the price determination, this price determination is going to be done on the stock exchange using the demand and supply mechanism. Next, liquidity. The financial market, one of the function is to provide liquidity for securities. What is liquidity? Liquidity is nothing but I already explained a few minutes back. It is how quickly we can convert any kind of asset into cash. The conversion of asset into cash, the quicker you can do, the more liquid that particular instrument is. So whenever we talk about any instrument or security of the financial market, the most important element to that is actually liquidity. You can quickly convert it because we have set up something called as the stock exchange, where trading, where buying and selling of securities can take place. So it says that the financial market provides liquidity to the tradable assets by facilitating the exchange, that is the stock exchange, as the investors can readily sell their securities and convert the assets into cash. So if they have securities, they can just go to the stock exchange, place an order of sell and get the cash for that particular transaction. And this facility, this liquidity is provided by the financial market. Next, cost reduction. Reduction in cost with reference to getting valuable information. They say that the financial market reduces the cost by providing valuable information regarding the securities traded in the financial market. Earlier, now we are all online, everything screen based. All the information you will get on the tips of your finger. You go to the internet, you'll get all the information. You open the news channels, you'll get all the details, right? But times back, let's go back a few years back, a few decades back, where even the stock exchange was in the physical form. All the markets were in physical existence, where if you wanted to know what is the price of the share, you had to be physically present in the stock exchange to know the details. To get those details, we had to get in touch with the brokers. We had to give them brokerage charges, even to get basic information about what is the price of the shares of company A. You had to contact somebody who's already actually physically there in the stock exchange to give you out those details. Information was money consuming, but now everything is available at the tip of your finger because we have moved to screen based trading, we have moved to online trading. Information is rightly available for you, but that was not there few years back. We have adopted the technology, we have moved ahead with the times. That is why now getting valuable information, it's not cost consuming, you get it free of cost. That is what is facilitated by the financial market, because the market has moved and developed over a given duration of time. Next, its next function is no physical delivery. What do we mean by that? We mean that if we talk about back then, whenever we bought a share, we used to get a certificate that, take, this is the share certificate, you have given us 1 lakh rupees, I am giving you a document which is proving that you have given me 1 lakh rupees. If all of you pass your exams, you will get a physical marks card, you will get a degree certificate that, see, this is a proof that you have completed this course, you have cleared all the exams. This document is a proof of that. Similarly, whenever we made an investment in the market, we got a proof by a physical document that this is the share certificate, or this is the bond, or this is the debenture. This is the proof of your investment. But over a period of time, there were a lot of disadvantages, plus we move ahead with technology. So in that case, now we have moved forward to something called as dematerialization. That is nothing but we have moved to electronic form. We have converted the physical share certificates into electronic form, and these electronic form share certificates are called as demat securities or demat shares. We have converted the physical documents into electronic form. Like you keep your money in your bank account. You can transfer from one bank account to the other bank account without actually having or handling the physical cash. Similarly, the shares can be transferred from one demat account to the other demat account without physically having the physical share certificate. Everything is converted into electronic format. We have demat shares now, everything is in electronic form. So that is why we say that there is no need for physical delivery, because we are directly doing account to account transfer. There is no need for us to actually get the physical delivery of the certificate. So it facilitates the exchange of assets without actually physical delivery. Without the physical delivery also, we can get the proof of investment into our demat account, that is electronic shares you are going to get. Okay, so those are the 5 primary functions of the financial market. Now let's identify who are the participants in the financial market. So I'm not moving ahead to the second concept of the chapter. We're still identifying or still seeing through what is the financial market and its classification. To understand that, you should know who are the basic important elements who are constituting the market. The first one is the issuer of the security. Who issues the security? The person who is in need of money is going to get money from somewhere. As a proof of that money, he has to issue a security. So the issuer of security is a person who is in need of capital. That is nothing but your companies or corporate organizations and the government undertakings. So who is the issuer of security? Anybody who is going to raise capital by issuing securities is the issuer of the securities. It could be companies or it could be government authorities. So entities in the corporate field that raise funds from various sources in the market are the basic requirement for the market to function. Second one is the investor. People who have surplus money, who are going to make an investment in the securities that are issued by the issuer, are called investors. So the investors are the people who actually keep the market active by investing their funds. Imagine that the companies are issuing securities, but the investors are not making an investment. The market itself is not active. You do not have investors. What is the point in making an issue of these securities when you do not have investors at all? Or on the other hand, you do not have the issuers, but you have the investors. But where are the investors going to put their money when the organizations are not issuing any kind of securities at all? So that is why both these people are interdependent upon each other. Only when there is a requirement of money, people can make an investment. Right? Only when people are ready to make an investment, the companies can think of raising money by issuing these forms of securities. So these two participants are interdependent upon each other, issuer of the security and the investors. And thirdly, we have the financial market intermediaries who are going to help us connect these two people with each other. The issuer of security and the investor. These two people will be connected with each other through the financial intermediaries. That means financial intermediary is a middleman. It facilitates connection of two category of people. So it is the people who act as middlemen between the issuer and the investors. These are the people who are going to ensure that the financial market functions efficiently, smoothly, without any problem. They are going to help these two people achieve what they want to achieve by connecting them with each other. So these are the three primary participants in the market who help the functioning of the financial market as a whole. Even if one of them is not there, even one of them is absent, the market is not going to function. There is going to be a problem in ultimately achieving the objective of the financial market. Next. Coming to the classification of the financial market, like I said in the beginning, financial market is a wider terminology for a very big market. That market is further subdivided and classified. It has various different segments. So the primary segments are money market and capital market. Money market and capital market. And capital market further has one more element, that is the securities market, which is further subdivided into primary market and a secondary market. Let's get into details of each one of these markets and identify what they mean and what is their role within the financial market. Now, I know that as a subject, our main domain or our level of expertise is going to be in relation to the capital market. This is the area of our subject. We have to focus on this market, that is the capital market, and in relation specifically the securities market. But to identify, know the basics about the working of the market, we have to go through certain aspects of money market as well. So first, let's begin by understanding what is the money market, and then we'll move towards the capital market. So by the name itself, you know some kind of monetary money, financial transactions are going to be involved. So when we say financial market, the role of financial market is flow of money from people who have access to the people who are in need. In money market also that is only happening. In capital market also that is only happening, because that both this money market and capital market are a part of the financial market. So the objective of both these markets is also going to be flow of money, but the difference arises in the duration of investment. It depends on the maturity period. So now money market is that area where the investment is going to be made for a shorter duration of time. So it says that this money market is a segment of the financial market where the borrowing and lending is for short-term funds. The investment is going to be for a short duration of time, anywhere between 1 day to 1 year. So your maturity period or the duration of investment is only and only within a year. 1 day, it could be 1 day, 4 days, 5 days, 7 days, or 1 year, but within the 1 year duration. So if you have made an investment in any instruments whose maturity duration is within a year, then that instrument is a money market instrument, or you are making an investment in the money market. So that is what we talk about maturity. The maturity of money market instrument ranges anywhere between 1 day to 1 year. So now here we don't mean to say that when is the investor buying and when is the investor selling. We are not thinking from the investor's point of view. We are going to see the terms and conditions of the issue of instrument. When the instrument is being issued, when the security is being issued, we are going to see what are the terms and conditions and what is the maturity period or what is the duration of investment. We are not going to see when one investor bought it and when the investor sold it. That is not relevant for us. When we talk about maturity period, we want to see what is the terms and conditions of the issue. At the issue time only, if they are declared that the maturity period is less than 1 year, then we classify it as a money market instrument. Because whenever we make an, let's say for example, I bought the shares of a company today. After 5 days, I need money and I liquidate my asset and sell it. It's within 5 days. And people are there who do everyday trading. In the morning they buy, evening they sell it off, because they've made that enough amount of profit. So when people are buying on the same day, selling on the same day, or within a duration of 1 week, they are buying and selling activities, in that case, can you classify that investment as a short-term investment or a money market investment? Absolutely not, because the company has issued the shares permanently. Till it is not calling back, till it is not winding up, the shares of the company are permanently going to be in existence. It does not have a maturity period. It is a long-term investment. So we are going to see the terms of issue. The company has permanently issued the equity shares. You are buying and selling on some random days. That will not determine whether it is a money market instrument or capital market instrument. We are going to actually see the terms and conditions of the issue to determine whether it is a money market instrument or a capital market instrument. If the duration is within a 1 year period, we classify it as a money market instrument. The regulators of the money market are RBI and the Securities and Exchange Board of India. Let's see what are the nature of transactions that form a part of a money market. First and foremost, large in amount and high in volume. So we are talking about two things. We are talking about the amount and we are talking about the volume. High in amount, that is, you're talking crores of rupees, 50 crores, 60 crores, right? Huge in amount. Whenever huge amount is there, obviously the volume in terms of units or in terms of per piece is also going to increase. For example, if I have 1000 rupees, I will be able to get 1 unit. If I have 10,000 rupees, I will be able to get 10,000 units. Oh, sorry, I will be able to get 10 units. If 1 unit is for 1000, I have 10,000, I'll get 10 units. So higher the amount, higher the number of units or higher the volume of the transaction. That is what they are saying, that in money market, the transactions that take place is high in amount. A lot of money is involved. Because a lot of money is involved, the volume of the transaction in terms of number of units being bought and sold is also very high. Coming to the other aspect, because a huge amount of money is involved, we have a very small number of people who are involved in money market transactions, because not everybody has so much surplus available with them that they can make investment in the money market. We do not have a lot of rich people or a lot of high net worth individuals in our country. Majority of us are middle class, or we are considered as retail individual investors. Right? So we have a very few people who are extensively rich or high net worth individuals to actually have that amount of money available for the purpose of making the investment. So that is why we say that in the money market, we have very small number of players, but these small number of players are having large amounts of money. So they are large players. Small number of people is less, but the transactions that they undertake is large. So what are the transactions? Huge amount, huge volume. A lot of people do not have that much money. So very small number of people undertake money market transactions. Even though small number of people undertake huge transactions, because they are large players, they have a lot of money in hand. So these are the kind of transactions that take place in the money market. Examples of money, okay, characteristics of money market instruments. Again, it is going to be similar to that of the financial market because it is a segment of the financial market. We have liquidity. You can buy and sell at any given point in time without wondering about the maturity period. Minimum transaction cost, because the maturity period is from a few days to within a year. So there is no long-term commitment. So there is no much transaction cost that is going to be involved. And lastly, no loss in value, because the duration of investment is within a year. Within 1 year, what capital appreciation or what capital depreciation are you going to see? So there is no loss in value itself within a given short duration of time. So these are the primary 3 characteristics of a money market instrument. Let's quickly see what are the features or what are the examples of money market. Treasury bills, commercial papers and certificate of deposits are examples of money market instruments. Now let's quickly move to our subject matter, our area of expertise that we have to focus on, that is the capital market. Capital market again is a part of the financial market. So again, the objective of the market itself is transferring or ensuring the flow of funds from the investors to the people who are in need of these funds, to the people who are in need of the capital. Right? But when we talk about the capital market, we are specifically talking in relation to 3 things. One is it deals with the industrial securities, that is nothing but your corporate organizations raising funds. It deals with government securities market, place where the government organizations can raise capital, and it also deals with long-term loan market where banks and financial institutions are going to extend this financial support to corporate organizations as well as government undertakings. So we are talking about a market where the investment is going to be for a longer duration of time. Medium to long-term investment, any investment over and above 1 year will come under the category of capital market investment, where we are going to focus on 3 elements: corporate securities, government securities and bank loans and long-term loans. So it is also referred to as the barometer of the economy. Why do we say that? What is a barometer? It is nothing but an indicator, a tool of measurement of how a particular thing is performing, right? So here we say that the capital market is the barometer of the economy. It is an indicator of how the economy is functioning, because if your capital market is performing well, your economy is also performing well. If there is some kind of problem in the capital market, that is going to reflect even in the economy of the country. So how your capital market is performing, it measures how well your economy is performing as well. So capital market is a direct indicator of how a country's economy is going to perform. The primary regulators of the capital market are SEBI, RBI, IRDA and PFRDA. Securities Exchange Board of India, Reserve Bank of India, the Insurance and Regulatory Development Authority of India, the Provident Fund Regulatory Development Authority. These are the 4 primary regulators of the capital market. But again, significantly, when we talk about the securities market, it is the Securities and Exchange Board of India which is the primary regulator of the securities market, right? So these are the regulators. Moving ahead to what are the nature of transactions that take place in the capital market. Like I've already told, the maturity is anywhere between medium and long term. Anything over and above 1 year will be capital market, right? So it is medium and long term liquidity needs, and the funds are pooled and made available to business, government and individuals. The business can issue corporate securities like shares, bonds, debentures. The government can issue bonds. The individuals can go and avail loans, long-term loans, housing loans from the banks and financial institutions. Examples of capital market instruments are share, stock, debenture, bonds, etc. Now, why is there a need for us to have a capital market? We have seen what is the financial market. We have seen that the financial market is classified into money market and capital market. We have seen what is money market, capital market. Our area of expertise or our area of subject is specifically capital market. So we are going to only concentrate on why is there a requirement for having a capital market? How does the capital market help various different category of people? That is what we are going to identify here. First and foremost, capital market plays an extremely important role in promoting and sustaining the growth of an economy. How is that possible? How can a capital market help the growth of an economy? How can the capital market promote the development of an economy? Simple logic that I've already told, that there is an investor, he has funds. These funds can be given to business organizations as a capital so that money can actually be put into productive use, where the businesses can actually produce goods and services and generate income. This income is the income of the business. In addition to that, this income is also reflecting the GDP. It is also helping, it is also considered as income within the country. Income of the country. So when the income of the country is going to increase by this setup, it is going to focus on the growth of the economy. Plus, when the manufacturing capacity increases, the same products, same goods and services can also exported elsewhere. More exports is more growth of the economy as well. So this channel of flow of funds from the people who have excess, by giving it to business houses or organizations for increasing the production within the country, will directly impact the income of the nation, which is going to focus on growth of the economy. So it is going to be helpful for the country's economy. Second, it is important and efficient to channel and mobilize the funds to enterprises, both private and government. So this particular capital market actually helps the businesses to get the capital from the investors. So if this market is not there, that flow of money is not going to be there. The business cannot issue securities and raise money from investors. If there is no long-term market, the capital market is not there, they will not get capital for long duration. That is why this capital market is required for the business and the government organizations. First point, we saw how it is helpful for the country, how it is required for the growth of the economy. Second point, we saw how capital market is required for the businesses and the government organizations for raising capital so that the money can be put into productive use. And thirdly, it is important for the investors as well, because they are getting an opportunity of making investment. They are getting one additional source of investment by investing in the capital market. So we identify the need of capital market. There is a need for the country's growth. There is a need for businesses to raise their capital. There is a need of this market for the investors so that they can get an extra source of making an investment. In addition to these three factors, you also need the capital market for various other reasons. For next one being for getting some kind of reputation at the international level, building your name, goodwill at the international level. So if you're going to mobilize the savings for investment and putting it to productive assets, you are going to enhance the country's long-term growth prospect. Plus, you're also transforming the economy into a more efficient, innovative and competitive marketplace at the global level or at the international level. If you are going to have that amount of money, you can actually do wonders with money. You have great ideas, you have a lot of innovation that can keep your company at certain other level itself at the international level. So that is what they are achieving. It can create a competitive marketplace at the global level if we are going to put the money into productive use. Next, in addition to the resource allocation, it also helps in providing a medium for risk management by allowing diversification of risk in the economy. So the market also provides you various different avenues, various different securities. You have so many different sectors. You can manage the risk very, very efficiently by making an investment in the capital market. Next, a well-functioning capital market also tends to improve the information quality as it plays a major role in encouraging the adoption of stronger corporate governance principles, thus supporting a trading environment which is founded on integrity. So if there is a capital market, they are going to expect that we as companies give out the information to the investors at large, because there is a requirement for giving quality information out in the public domain, it is definitely going to impact the corporate governance principles within the organization. We are going to see a lot of companies following these corporate governance aspects within the companies. Capital market has played a crucial role in supporting periods of technological progress and economic development throughout the history. Like just I was saying a few minutes back that we were physical stock exchanges. From physical stock exchanges, now we have moved to online screen-based stock exchanges, right? So that technological development we have seen. We have adopted the technology with time. That has been possible only because there was an existence of the capital market. So we have to move ahead with the changing times. Capital market also provides a valuable source of external finance. So it is not that you can raise money through the capital market only from the Indian investors. You can also raise money from foreign investors. You also have source of money from other countries. You can raise money from other countries as well by establishing a capital market. So for all these reasons, there is a requirement for having a capital market. Next, what are the major functions of the capital market? First one, to mobilize the resources for investment. Mobilization is nothing but ensuring the flow of money, movement of money from one person to the other person. That is nothing but people who have access to the people who are in need. That facility is provided by the capital market. To facilitate buying and selling of securities. Buying and selling of securities, nothing but trading of securities. For that purpose, you need a stock exchange, and that stock exchange is established. It is a part of the capital market. To facilitate the process of efficient price discovery. We know that by now the price in the market for buying and selling the shares is solely depend upon demand and supply, and this demand and supply mechanism can be identified, calculated over the stock exchange. So the capital market also facilitates the efficient process of price discovery. Next, to facilitate settlement of transactions in accordance with the predetermined time schedules. What do you mean by settlement of trade or settlement of a transaction? Let's assume there is one person. He has 10,000 shares of company A. He has 10,000 shares of company A. He is in need of funds, and now he is planning to sell all these 10,000 shares. For that, he goes to the stock exchange and places an order of sell for 10,000 shares of this company A. Now, where are we going to get the buyers? Because buyers are situated throughout the country. So any person who is trying to buy the shares of this company will be linked to this particular transaction. So let's assume there is one more person. He is planning to buy 8,000 shares. And there is one more person who is trying to buy 2,000 shares. So these two people will be connected with this person, and this entire 10,000 shares will be sold to one person who wants 8,000 shares to other person who has 2,000 shares. The most important thing in the stock exchange or in these transactions is we don't know who is the seller and we don't know who is the buyer. I only know that I'm going to sell the shares. To whom am I going to sell? I don't know. I don't know from my demat account to which demat account the shares have gone. I will not know because all the transactions are anonymous. We will not get to know to whom we have sold. The buyer will also not get to know from whom he has bought these shares. All this order matching transactions take place on the stock exchange using high-end technology, right? So this is settlement. What is settlement? Where you have a person who is trying to sell, that person should be connected with somebody who wants to buy. This connection is going to take place. Then what should happen ultimately? He should get his cash and his demat account should not reflect the shares. On the other hand, for these two people, they should pay the money, cash should go out of their bank account and their demat account should reflect the shares. So how long will it take for a person to get his cash and how long will it take for these people to get their shares in the demat account is what we call as the settlement cycle. how long will it take? If I'm placing the order today, how many days will it take to reflect in my bank account or in my demat account? Is the settlement cycle. So that is what they want to facilitate, where they're saying that they want to facilitate settlement of the transactions in accordance with the predetermined time schedules. Time and again, the Securities and Exchange Board of India is trying to reduce this settlement cycle as less as possible. When we started, it was T plus 15 days. Then they reduced it to T plus 7 days. Now we have T plus 2 days, T plus 3 days, you get the transactions. They are planning to achieve the settlement cycle of T plus 1 day and ultimately the T day. The same day you execute the transaction, the same day they want you to see that reflecting in your demat account and bank accounts as well. So the Securities Exchange Board of India is working towards reducing the settlement duration, reducing the settlement cycle. That is what is the objective of the capital market. Next. Like I told, capital market also includes one more segment which is called as the securities market. Now let us see what is the securities market. Securities market is specifically in relation to corporates, where they can raise money by issuing securities like equity shares, debentures, derivative, mutual funds, and it is a long list. So wherever you find a market where the companies can raise funds by issuing any one of these securities, it is called as the securities market. Now, the securities market provides a platform where we can issue. The securities are issued to the investors, that is public at large, and these investors can further buy and sell various securities, that is share, bonds, etc. So what are they telling here? Here we are talking about the classification of the securities market. They are saying that the securities market has two elements. What are the two elements? One element is where the company is actually going to make an issue of these securities to the investors. What? It is a place, first segment of the securities market is a place where the company can issue these securities to the investors at large or public at large. Once the investors already have the shares, you're going to issue. So now these people are going to become the shareholders or security holders. These security holders in the future might want to sell the securities that they hold, or they might want to buy the securities on which they do not currently have any kind of rights. So for that they will need a marketplace. So the securities market is also going to provide the investors an opportunity where they can undertake buying and selling activity amongst each other. I am an investor, I have a share of company A. One more investor is there, he has the shares of company B. Now I want the shares of company B, he can sell it to me. In this market, in the second aspect, company is not going to be involved. The investors are going to buy and sell the securities which they have in their hand. So what is it? This first market where the companies are going to make an issue of shares to the investors is called as the primary market. And the place where the investors can buy and sell and undertake the trading activities, that market is called as the secondary market. Is called as the secondary market. So you should associate each one of these markets with one word. Primary market is always connected with the word issue, and the secondary market is always associated with the word trading. Trading means buying and selling. Clear? Okay. Now, let's see what are the primary functions of the securities market. They say that this securities market enables the allocation of savings from the investors to the people who are in need for the purpose of business. This is the same thing that we are seeing right from the beginning about what is the objective of the financial market. It is the same thing because all these are segments of the financial market. The objective of all the markets is going to be the same. Just the terms and conditions and the duration of investment is going to be slightly different. So here also we are going to channelize the funds from the investors to the corporates or the company form of organizations. This is done when the investors make investment in the securities or companies that are in need of funds. Basically, that is what is going to happen. Now, What are the benefits of making an investment in the securities? So we are investors. If we want to make an investment in the securities market, we will have some kind of need. We will look for some objective. Why will we make an investment? There should be some benefit for us also, for us to give that money to the companies. That is nothing but that we discussed some time back. It is the benefit or return that we get in the form of interest, dividend, capital appreciation, bonus. What is interest? It is a fixed rate that the organizations or the government pay on debt instruments. Dividend, a share of their profit is going to be shared with the equity shareholders or preference shareholders. What is capital appreciation is what we have to discuss. We'll get into those details, but we'll see the second point as well about what is the benefit. Such investments contribute to the economic development of the country as well. So we have already seen how the market can directly impact the economy of the country as well. So that point also we know. So it is beneficial for the investors and it is beneficial for the country as a whole as well. Now let's focus on one point, that is capital appreciation. Do you all know what is the meaning of the word capital appreciation? Capital appreciation. What is capital appreciation? Any idea? What is capital appreciation? Capital is nothing but the amount or the money that we are going to make an investment, right? And what is appreciation? Appreciation is nothing but increase in the value of investment. So the amount that you have invested is the capital. The increase in the value of your investment is appreciation. So what is capital appreciation? Let's just take a quick example to understand it. Let's assume there is one person. He bought the share on 1st January 2024 at rupees 100 per share. He bought one share at 100 rupees on 1st January. Now, when he wants to sell it, let's assume that this person is planning to sell the security on 30th July 2024. After the duration of 7 months, he can, if he wants to sell the share, he will be able to sell it, let's assume, at 150 rupees per share. So what has happened? When he bought one share, he was able to buy it at 100 rupees. But now when he is going to sell the same share, he can sell it at 50 rupees. So the capital appreciation here or the direct profit that he can make is 50 rupees. There is an increase in the value of the asset that he is holding. He bought it at 50 rupees, today he can sell it at 150 rupees. That itself is capital appreciation. The value of his investment has increased over a given duration of time. Over a duration of 7 months, his asset has increased its value, right? That is capital appreciation. The same thing can be applied anywhere. For example, let's assume that one person had bought a plot of land at 20 lakh rupees in the year 2012. When the city was not developed, it was at the outskirts of the city, right? He bought it for the purpose of investment. Now, in the year 2024, if he wants to sell that property, the same property can be sold off at somewhere around 1.5 crore rupees. His value of investment has increased significantly. This is capital appreciation, that when he bought the plot of land, it was available for 20 lakhs. Today, if he is going to sell the same plot of land, he can sell it at 1.5 crore rupees. The value of his investment has increased over a given duration of time. That itself is capital appreciation. Whenever there is an increase in the value of your investment, there is capital appreciation, that is profit for the investors, and that is why we say that this is one of the benefits for the investors who are going to make an investment in the securities market. But it is not always that you are only going to see capital appreciation. There can also be a situation where there can be capital depreciation. Now, what is capital depreciation? It is exactly opposite of what happens in appreciation. Depreciation is nothing but reduction in the value of investment. For example, a person had bought a share at 100 rupees per share. Now, when he is going to sell it or he is trying to sell it, he will be able to fetch only 80 rupees per share. So here he has a loss of 20 rupees per share. This is capital depreciation. The value of your investment has reduced over a significant given duration of time. So what investors want is capital appreciation and not capital depreciation. But like I said, the securities market is not risk-free. There might be situations where the companies are performing well and everything is right. In that case, there will be capital appreciation. And in case where the companies are not performing well, there are disputes, there are scams, there is going to be capital depreciation. So the investor should be beware about which company they are making an investment in. Okay, so the benefit is capital appreciation and not capital depreciation. So these are the primary benefits of making an investment in the securities market. Investors can get returns by the way of dividend, interest, capital appreciation, bonus and like reasons, and this investment by investors in the securities market can also help the development of the economy. Next. Classification of the securities market. I've already told you that the securities market is predominantly classified into primary market and a secondary market. Let's see certain more details of these two markets. They say securities market has two interdependent and inseparable segments, being primary market and a secondary market. What are they meaning? They are saying that primary market and secondary market are interdependent upon each other. Without one, the other cannot exist, and they are inseparable. You cannot separate these two markets from each other. Both the markets go hand in hand. Both the markets perform parallelly. If one market is not there, the other cannot function. If the other is not there, the prior one cannot function. Both the markets are linked to each other. For one market to perform well, the other market's requirement is there. What do I mean by this? Let's take a quick example. If there is a primary market, but there is no secondary market. What is primary market? Primary market is associated with the word issue. And secondary market is a place where trading takes place, where buying and selling takes place. If the companies are able to issue it in the market, but later there is no secondary market, that means there is no trading that can take place. That is, no buying and selling can take place. That means there is no further continuous market. And if there is no continuous market, obviously there is no liquidity in the market. If no liquidity is there, why will any investor make an investment in this company and purchase the share of these companies? Because primarily we are looking for liquidity. We do not want to lock our money. We do not want to personally go and look for the buyers of our securities. So even if you have an issue, even if you have a primary market where the companies can make an issue, but if the secondary market is not in existence, if you don't have a further continuous market for the purpose of trading of those securities, the investors will not be inclined in making an investment in this particular company. So yes, if you want a primary market to function well, if you want investors to make an investment in the primary market, you should provide them the secondary market and give them the confidence that at any given point in time, you can liquidate your assets. On the other hand, if we take other example, let's assume that there is no primary market, but there is a secondary market in existence. That means, let's assume iPhone 20 Pro is not there. The company has announced that we are going to launch iPhone 20 Pro on so and so date. Before that date, can you buy the phone? Until and unless there is no issue only is not done. What is the commodity or subject matter that you are going to buy or sell? Only if issue is done, the commodity is made available in the market. Only if in the market the commodity is available, you can buy and sell. So if there is no issue only that is being made, what is the thing that you are going to buy and sell? You do not have the commodity or subject matter itself. You have no securities for buying and selling because nothing has been issued in the primary market. So that is why we say that if there is primary market and secondary market, no secondary market, primary market does not function properly. There will be no efficiency. Investors will not have an inclination of making an investment in the primary market where the secondary market is not there. On the other hand, when you have a secondary market but no primary market, you do not have a product itself for buying and selling, so they cannot function without each other. So for the primary market's existence, there is a very much requirement of a secondary market, and similarly for the existence of the secondary market, there is a requirement for the existence of the primary market. So these two markets, primary market and secondary market, are interdependent upon each other and they are inseparable segments of each other. One market cannot function without the existence of the other market. Even if one market is not there, the entire securities market is going to go for a downfall because there is no efficiency in the market. I hope that is clear. Now, let's specifically look into what is primary market and then we will go into what is the secondary market. We already know that we are going to associate the primary market with one terminology, that is issue, where for the first time new securities are going to be issued by the company. That place where the issue takes place is the primary market. So the primary market deals with the issue of new instruments by two kind of organizations that you already know, the corporate sector and the government organizations. The corporate sectors can issue securities in the form of equity shares, preference share, corporate bonds, debentures, and the government, that is the central and state government or various public sector undertakings, can issue the bonds and debt instruments. For example, the National Highway Authority of India issue bonds. The electricity boards issue bonds. So these are the two category of people who are going to raise money or capital from the primary market by issuing securities. So that place where the companies and the government issue the shares for the first time to the investors, that market is called as the primary market. This market is of great significance for the economy of the country, as it is in this market through which the funds are actually transferred or it flows for productive purpose from the investors to the entrepreneurs. Because like I told you, in the primary market we are issuing the shares. So there is an investor, he has money. This money he is going to give to the company. It becomes the capital for the company. Because he is receiving capital, he is going to issue equity shares. For example, equity shares. So this is the market where actually the money is being transferred from the investor to the company and it can be reflected in the share capital account of the company. It is actually making an impact in the financial statements of a company. So primary market transactions are the actual transactions through which the money is transferred from the investors to the companies. The primary market in which public issue of securities is made through prospectus is a retail market and there is no physical location as such. So it is all the public issues are also done via the stock exchange, in the sense the platform is used for doing the transactions. There is no physical location as such. It is a retail market, and this market is also known as the IPO market or the initial public offer market, because for the first time the company is going to issue the shares of its company to the public at large. That is why we call it as the public primary market or the initial public offer market. Now, who are the two major types of issuers? You already know it is the corporate entities who can issue equity share, preference share, debentures, corporate bonds, and the next one is government organizations which can issue instruments like bonds. Now, in addition to IPO, the company also has other ways of raising capital. What is happening in initial public offer? We are going to make an invitation to the public at large. We are going to issue a prospectus that please come and subscribe to the shares of our company. We are making an initial public offer. Public at large, we are going to invite you. Please come and buy the shares of our company. That is initial public offer. To public at large, we are going to make an invitation. But apart from an initial public offer, companies also have alternative ways of raising capital, one of which is qualified institutional placement, where you are going to invite people or certain selected group or selected category of people to make an investment, like qualified institutional buyers. Only selected category of people are invited to subscribe to the shares of your company. Or you also have a source at the international level. You can raise money from the international market by issuing ADR, GDR or external commercial borrowings. So you not only have an option of raising money by making an initial public offer, you can also make qualified institutional placements. You can also raise money from the international market by issuing ADR, GDR as well as ECBs. So these are the various avenues through which the companies can raise capital. Next, coming to secondary market. The secondary market itself is known as the stock exchange. So the secondary market or the stock exchange is a market for trading and settlement of securities that have already been issued, where issued in the primary market. And you're going to associate the word secondary market with the term trading. That means buying and selling of securities. Right? So what is happening here? In the secondary market, we are going to buy and sell the securities which are already issued in the primary market. Once the investors become the shareholders by getting the shares in the initial public offer or in the primary market, they will become existing shareholders of the company. At any point in time, if they want to sell their shares, or there are other investors who want to buy the shares of this company, they can go to the stock exchange and buy the shares or sell the shares depending upon their requirement. That facility is going to be provided on a marketplace, and that marketplace is called as the secondary market or the stock exchange. The secondary market provides a trading place for the securities that have already been issued for the purpose of buying and selling. It also provides liquidity to the initial buyers in the primary market to re-offer these securities to any interested buyers at a price if it is going to be mutually agreed. So what are they telling here? They are telling that in the primary market, we have the parties, that is the investor, and you have the company. Investor is going to give the money to the company. Company is going to issue the shares. For example, I am taking equity shares. Right? So like this, lakhs of investors or crores of investors are going to make an application to the company for the purpose of getting the shares. But only a few of them are going to be selected. So let's just take one person who has got the shares in the primary market. So now after the issue is completed, he has become the shareholder of the company. There was one more person whose application was rejected in the primary market, and that is why he is not the shareholder of the company. So here what has happened, one person is there who has the shares of the company. There is one more person who does not have the shares of the company. Right? This is the ultimate conclusion of the primary market. You make an application to get the shares. A few applications are selected, a few applications are rejected. If your application is selected, you become the shareholder of the company. If your application is rejected, you get no shares of the company. Now this market transaction completed. Once this entire transaction is completed, the work in the primary market is completed. Once the work is completed, this company will be moved to the stock exchange. It will be moved to the secondary market. What is going to happen here in the stock exchange? What is going to happen? There is one person who is the shareholder. There is one person who is not the shareholder. We will call him as the investor because he does not have the shares of that particular company. The shareholder might want to sell his shares. An investor who did not get the shares, he might want to buy the shares. Or the same person who is an existing shareholder, he might want to buy more shares. A number of possibilities are there, and these people who have these intentions of buying and selling the securities can undertake the transactions on the stock exchange by using their trading platform. So in the stock exchange, the transactions are going to take place among investors themselves. Somebody wants to buy, somebody wants to sell. The market is going to connect these two people with each other so that the entire transaction can be completed. One is going to be the buyer, one is going to be the seller. The market is going to use order matching mechanisms to connect these two people with each other and complete that particular transaction. So what happens in the primary market? You're issuing the securities. Thereafter, people who have got their securities might want to sell it, so they can sell it on the stock exchange. That is the secondary market. So what happens in the secondary market? They are saying that it provides liquidity to the initial buyers who have got the shares in the initial public offer, so that they can re-offer it to any people who are interested in buying the shares at any price that is predominant on the stock exchange. Now, in the secondary market, the investors holding securities are going to sell the securities through registered stock brokers of the stock exchange. Similarly, the investors who are interested in buying the securities, they are also required to purchase these shares from the stock exchange only through registered stock brokers. What do we mean? There is an investor who is an existing shareholder. He wants to sell his share. There is an investor who was not a shareholder, but he actually wants to buy the share. He can buy the share. The people who want to sell, they can sell it on the stock exchange. People who want to buy it can buy it on the stock exchange. But the most important point that you should remember is an investor can never directly place an order for buying or selling on the stock exchange. They require one intermediary to be involved in between, who is called as the stock broker. Investor has to first open an account, that is a broking account, with the stock broker. He is going to place his order with the stock broker. I want to buy the shares of so and so company. I want to sell the shares of so and so company. He is going to tell the stock broker. The stock broker is further going to place the order on the stock exchange. Right? So the investors can never directly contact the stock exchange. That is not possible, and this has been done merely for regulatory perspective, only for regulating the market to see that everything is proper, no malpractices are taking place. We have created this intermediary system. The stockbrokers are required to do KYC for all the investors. They should ensure that the investors are not resorting to any fraudulent practices. So all the KYC requirement the stockbrokers are going to do. And the stock exchange is required to monitor the stockbrokers. They have to, this is the master, and he is the agent. Master-agent relationship is created between the stock exchange and stockbrokers. So they should ensure, stock exchange should ensure that the stockbrokers are functioning properly. And that is why they say that you should undertake this buying and selling activities on the stock exchange through the stockbrokers who are registered. What do you mean by registered stockbrokers? The stockbrokers are required to obtain a license from the Securities and Exchange Board of India before undertaking the stockbroking activities. So merely for ensuring compliance, ensuring everything is proper for the purpose of regulatory requirement, we have created this system where the investor contacts the stockbroker. Stockbroker in turn undertakes the transactions on the stock exchange. The investor is required to open a stockbroking account with the stockbroker. The stockbroker is going to register himself as a trading member on the stock exchange. In addition to that, the stockbroker also has to obtain a license to function as a stockbroker from the Securities and Exchange Board of India. So in short, the investor can never directly contact the stock exchange for buying or selling any kind of securities. He has to contact his stockbroker for executing those transactions. It may have physical location like a stock exchange or a trading floor. So we have the National Stock Exchange, we have the Bombay Stock Exchange. Both of them are physically situated in Mumbai. But the transactions are online, but you have a physical location to those stock exchanges. Since 1995, trading in securities is now moved to screen-based and internet-based trading, and this is what has happened in India over a significant duration of time. I've already told you about this. Next, this statement is actually that primary statement which tells you why primary market and a secondary market are interdependent upon each other and are inseparable from each other. Let's read through this paragraph. It says that an active secondary market actually promotes the growth of the primary market, and it helps the capital formation because the investors in the primary market have the confidence that there is a continuous market for these investments and that they can liquidate their investments at any given point in time. What are they trying to communicate here? They are saying that if you have an active secondary market, what is an active secondary market? That means you have a lot of transactions taking place on the stock exchange. People are buying, people are selling, every day crores of transactions are taking place. That means the investors are interested in the securities market. They are actively participating, they are actually making investment in the securities market. That means they have some level of trust in the market. The market is active, people are interested in making an investment in the securities market. That gives confidence to the primary market. The other companies will get confidence that the market is performing so well, even we can use this market for raising capital. So it will encourage the other companies to raise capital, to form their capital by using the primary market, because they are confident that in the secondary market the investors are actively performing. And once the companies get confidence that we can raise capital through the primary market, they are going to make a public issue. Once a public issue is going to be made, it is going to come in the secondary market. For that, people are going to be confidently making an investment in the primary market only because they have a confidence that secondary market is in existence. If after primary market, secondary market is not there, the investors will not invest because there is no continuous market and no liquidity. But they are confident that after primary market, secondary market is there, we have a continuous market. Whenever we want, we can sell. Whenever we want, we can buy. We can liquidate our assets. So that is why that confidence is based. So the secondary market gives confidence to the primary market gives confidence to the secondary market. And that is why we say both these markets are associated with each other, are interdependent upon each other, are inseparable from each other. I hope that is clear. Now let's quickly have a Q&A session. That is nothing but a quick quiz on the basis of what we have studied till now. Let's see the first question. Which of the following is not a regulator of a financial market? Option A is SEBI. Option B is RBI. Option C is IRDAI. Option D is stock exchange. You can put it in the chat like question 1 and what is your option, A or B or C or D. Who is not the regulator of the stock exchange is what you have to answer. Yes? Which of the following is not a regulator of the financial market? The answer is, the right answer is D. Stock exchange is not a regulator of the financial market. You have RBI, SEBI and IRDAI. These three are the regulators of the financial market, but stock exchange is not a regulator. Next. Price of securities is determined on the basis of dash. You have to type your answer, so you can put it as question 2 and type your answer. The price of securities is determined on the basis of dash. On what basis is the price determined in the secondary market? How do we determine it? Yes? The answer is demand and supply. Right? Next. Two inseparable segments of the securities market are A. Capital market, B, money market, C, primary market, D, secondary market. So you have to identify which are the two markets that are inseparable and are interdependent upon each other. So you can put the answer in the chat box by putting question 3 and giving the right option. Which is the right option? Which are the two markets that are not separable from each other? Yes? So the answer is option C and D, that is primary market and a secondary market are not separable from each other. They are inseparable, they are interdependent upon each other. Next. Let's move to the next concept. We are going to see here the difference between primary market and secondary market. Please mark this concept as very, very important because the institute has time and again for 5 marks to ask the difference between primary market as well as the secondary market. Now, you already know what is the primary market, you already know what is the secondary market, you know how it operates. So, on the basis of that itself, we are going to identify certain differences. Now, let's first take the differences. Primary market, secondary market. What happens in the primary market? Quickly tell me. There is an investor. That investor is going to give money to the company. So there is flow of money and there is issuance of shares. So what is happening here? Who are the parties to the transaction? The parties to the transaction is the investor and the company. Second point, what happens to this money of the investor? That is reflecting in the company's financial statement as the share capital. So whatever money is collected, that becomes or that reflects as the share capital of the company. Next. Which is the intermediary that is going to be involved in this transaction? There is some concept called as underwriting. Underwriters are the intermediaries who are involved in the primary market. What is underwriting? Generally what happens? The company is issuing its shares. The company is calling public that please come and subscribe to the shares of our company. But the company does not know whether it will get a good response or a bad response. Whether the investors will be interested in buying the shares of their company or not. They don't know. If it is a good response, if people are subscribing to the shares, well and good, the company is happy. But what if the public is not interested in buying the shares of your company? Your public issue is not getting a good response from the public at large. For tackling that situation, when there is no good response, the company is required to hire somebody called as an underwriter and give them the responsibility that in case there is not enough subscription from the public, you have to help us subscribe to the shares of the company. That is the role of the underwriter, that in case public is not subscribing, they should step in and ensure that the company's shares are subscribed. So that is the intermediary who is going to be involved in this entire transaction in the primary market. What is the purpose or objective of this particular market? The whole objective is company is initiating this market. Company is raising capital. So the objective of the market is to form capital or raise capital for the companies or the government organizations. So these are the predominant four factors that you should keep in mind. What happens in the secondary market? You already know that there are investors who have certain shares, so they want to sell it. You have certain investors who do not have their shares and they want to buy it. So here we are going to undertake transactions among the investors itself. So the parties to the transactions in the secondary market are investors among themselves. One investor is purchasing from other investor, one investor is selling to the other investor. Second one is what happens to the money. If he is the seller, he is going to give the security to the other person. The person who is buying is going to give the money. What is going to happen to the money? Here, this money becomes the personal gain or personal loss of the investor. If there is capital appreciation, it is capital gain. If there is capital depreciation, there is a loss, and that is in relation to one investor. That is nothing to do with the capital of the company. So the company is nowhere involved in the secondary market. Company has nothing to do, not money wise, not transaction wise. Next, who is the intermediary who is going to be involved? We already know that it is the stockbroker. If the investor wants to buy and sell the securities on the stock exchange, they can do it only through a registered stockbroker. Lastly, what is the objective of the secondary market? It is to provide liquidity for the investors. And secondly, capital appreciation for the company. Because we know what is happening in the secondary market, we are also determining the price of the securities on the basis of demand and supply mechanism. We are determining the price of the securities on the basis of demand and supply mechanism. So every company will want the value of its shares to go up. They want the value of their shares to appreciate. That is the objective of the company, that they want capital appreciation. They want capital appreciation because that is going to impact their market capitalization. That is going to impact their market capitalization. Now, what does that mean? This means that in the secondary market, we know that the company is nowhere involved. The company has no direct relationship in the secondary market. But in one way, indirectly, they are interested in the secondary market because they want the company's share to perform well. To perform well, that means they want the share price. They want the market price of their shares to always increase over a given duration of time. Why is that? That is because that is going to help the company at the time of valuation. If you want to determine what is the value of one company, you are going to see what is the market price of their share on the stock exchange. If they have 1 lakh shares today and market price is at a certain value, you know that the value of company is so much. If the value falls, their value is decreasing, their market capitalization is decreasing. So they want, whenever we calculate the value of a company, this value, the market price of the shares on the stock exchange is a very, very important factor which helps us in calculate market capitalization. What is market capitalization? Market capitalization is nothing but market price of the shares as prevalent on the stock exchange as on a given date into the number of shares that are available in the market. That is market capitalization, and this market capitalization will increase only when the market price will increase. How will the market price increase? When there is more demand in the market. So that is what we are saying. The objective of the secondary market is to provide liquidity to the investors and to provide capital appreciation or increase in the market capitalization for the company. So, okay, these are the predominant differences between the primary market and the secondary market. Let's quickly look at the differences to identify the same. First one, what is the objective? We already know the objective of the primary market is to raise capital, whereas the objective of the secondary market is capital appreciation from the company's point of view and liquidity from the investor's point of view. Next, what is the scope? What is happening in the market? Here, there is issuance. Issue of new securities through initial public offer. Here, what is happening? We already know, we are associating it with the word trading. So, there is further trading of securities which are already offered in the primary market. So, buying and selling of securities is going to take place. What is another name for these markets? We call this market as the new issue market because new shares are issued in the market, or we call it as the initial public offer market. First time the shares are launched in the primary market, and for the secondary market we call it as an after issue market. After issue means issue has been completed in the primary market. After the issue has been done, those shares are available in the secondary market. That is why we call it as an after issue market. Next, purchasing of securities. Who purchases the securities? Here, investors can purchase the securities directly from the company. So, the transaction is taking place between the investor and the company. Company directly sells the share to the investor. Investor directly buys the security from the company. Whereas, in the secondary market, the buying and selling is going to take place from some other investor. The company is not directly involved. So, the purchase and sale of securities is done by investors among themselves. The company is not a party to the transaction. Next, what happens to the money? Financing. Here, primary market provides funds to new and old companies for their expansion as well as diversification. What is the objective? Why do they need money? It is for the purpose of expansion, for the purpose of diversification. They need capital. For raising that capital, they use the financing opportunity of the primary market. Why secondary market? It does not provide any funding. There is no capital formation at all. No capital formation for companies. Whatever happens becomes the wealth of the investors, becomes the profit or loss of the investors. It is nothing to do with the company. So, there is no financing that is happening as such to the companies. No funding is taking place in the secondary market. Parties to the transaction, we already know investor and the company are directly in relation to each other in the primary market, but in the secondary market, the transactions take place between two or more investors. So, investor among themselves are going to deal in the secondary market. Major intermediary that is going to be involved, I have already given an explanation. Here in the primary market, it is the underwriter who take the responsibility of successfully subscribing to the shares of the company when the public at large has not given a good response to the public issue. And in case of the secondary market, the intermediary is a stockbroker, because an investor can never directly contact the stock exchange for the regulatory perspective. The price. You already know that the price in the secondary market is determined on the basis of demand and supply mechanism. But we have not discussed about how the price is determined in the primary market. Let's see, and I'll give an explanation for the same. Price as given in the offer document or the red herring prospectus. So, they've just said that price is as mentioned in the offer document or as determined by the red herring prospectus. So, what does that mean? That means that whenever a company is planning to make a public issue, whenever a company is going to plan to make a public issue, they have two options. Two methods of making a public issue. One is called as the fixed price issue. One more is called as the book built issue. In the difference, we saw two terminologies are used. One is offer document and one is red herring prospectus. What does that mean? It means that when the company by itself has decided the price, it has fixed the price that we are going to sell the shares to the investors at 100 rupees per share. They have determined it. They have mentioned this already in the offer document, in the prospectus that we issue for inviting the people to subscribe to the shares. We are giving them an offer. We are selling our shares. We are launching our shares. Please come and subscribe to the shares of our company. Please come and buy the shares of our company at 100 rupees per share. We are going to use your money for so and so objective. We are raising so much total amount of money by making this public issue. All those details are mentioned in the offer document that is called as the prospectus. In that itself, they are going to clearly mention what is the price of the security, and it is going to be determined by the company itself. It is already fixed before the public issue is going to be made. They have determined it. What is the share price? That is called as the fixed price issue, where the company knows what is the value of their share and what price they want to sell their shares to the public at large. On the other hand, the second method is a book built issue. That issue is done by using a procedure called as book building procedure. What is a book building procedure and what happens here? Here, the company is not sure about at what price they want to sell their shares to the public at large in a public issue. So, we are asking the public, we are going to make an issue of our shares. You tell us at what price are you ready to buy the shares of our company? You tell us, you submit a bid application by telling us what is the money that you are ready to pay to buy one share of our company. You give us the price. We are conducting an auction where we ask them to give a bid. We want to sell our shares. You tell us at what price you are ready to buy the shares. That is a book building procedure where right at the beginning, the price is not known. Price is not mentioned because the company itself does not know. They are asking the public to tell them at what price they want to sell. That is why whenever we are going to make a issue through a book building procedure, we do not issue the offer document or the final prospectus. We issue a document called as a red herring prospectus, which is a type of prospectus in which certain details are missing with respect to the price or quantity of the shares that are going to be issued in the market through the public issue. So, what is a red herring prospectus? It is a prospectus which is going to be issued at the time of book building procedure where certain details are going to be missing, and that missing information is going to be with reference to the price of the securities or with respect to the quantity of securities that are going to be issued in the public issue. So, what has happened? The company wants to make a public issue. They have told the people to tell at what price they want to buy. They ask them to submit a bid application. So, you are going to receive a lot of application from a lot of investors, right? Once you receive all the application, using a lot of technology and formulas, we are going to arrive at the final issue price, and this issue price will be based on the bid applications that we have received from the investors. Once we complete the book building procedure, the company is then required to issue the final prospectus, issue the final offer document, and in that they have to mention that the price determined through the book building procedure is so and so, right? That is how we determine the price in the primary market. Now, in the book building procedure, can we just randomly tell the investors, you tell us at what price you want to buy? One will say 1 rupee, one will say 1000 rupees, one will say 100 rupees. How are we going to bring uniformity in the bid applications or in the quotations that we are going to receive from the investors? To bring that, the law says that the company has to give something called as the price range. They have to give the lower limit and the upper limit. They have to give them a range. Within that range, they are going to submit the bid applications. They can say lower limit is 70, maximum limit is 75. So, you can say that I as an investor, I am ready to buy the share at 70 rupees. Somebody else will say I am ready to buy at 73, somebody will say 78, somebody will say 85, somebody will say 95. So, within this limit itself, you can mention the price in the bid application. If you mention 69, your application will be rejected. If you mention 100, your application will be rejected. Only those applications which are mentioning the price within this price range, only those applications are going to be considered. So, the company definitely knows that the issue price is somewhere going to be between 70 and 95. But within that price, what is the exact price? They want to identify it from the investor. That is why the investors are required to submit the bidding applications. Once we receive all the applications using technology and formula, we are going to arrive at the final price. We are first going to issue a red herring prospectus. Once the final price is determined, the company is going to require to submit the final offer document or prospectus. So, this is how we are going to determine the price in the primary market. In case we are going by the fixed price issue, we are going to issue an offer document. In case we are going through the book built issue, we are going to issue the red herring prospectus. Whatever has been mentioned in these two prospectus, that way we are going to determine the price. That way we are going to arrive at a pricing for issue of shares in the primary market. In the secondary market, we already know it as demand and supply mechanism. Next, Utilization of fund. What is going to happen here? That money is going to reflect in the share capital of the company. It is going to reflect in the financial statements of the company. Whereas whatever money is there involved in the secondary market, that becomes the income of the investors in case there is capital appreciation. It becomes the loss of the investors in case there is capital depreciation. Okay, that is all about the difference between primary market and a secondary market. Now, because it is a very important topic, I have kept a separate Q&A only on the difference between primary and secondary market. So, let's quickly answer these quiz questions. Again, same format. In the chat, you can put the question number and give the right answer. So, question number 4 is, which of the following provides a trading place for securities already issued to be bought and sold? Answer. Options are primary market, secondary market, qualified institutional institutions, or money market. A, B, C, D. So, you have to give me the right answer, whether it is the primary market, secondary market, money market, or qualified institutional institutions. Which is that place which gives you a trading platform for already issued securities to be bought and sold? You just mention question 4 and the right answer. What is the right option? The right option is option B, that is the secondary market, where we are associating that market with the word trading. We are associating that market with the term buy and sell. So, a place where you can buy and sell already issued securities in the primary market is the secondary market. So, option B is the right answer. Let's get to the next question. Question 5. The parties to a transaction in the primary market are dash and in the secondary market are dash. Let's go through the options. Please be careful when you're answering this particular question. Option A is investors among themselves and the company and investor. So, this is in relation to primary market, this is in relation to secondary market. You should tell me which is the right one. Option B is in relation to primary market, they are telling company and the stock exchange, and with respect to secondary market, they are telling investors and the company. In relation to third option, in relation to primary market, they are telling company and investors, and in relation to secondary market, they are telling investors among themselves. In option D, they are telling in relation to primary market, it is the company and the promoters, and in relation to the secondary market, it is investors and the stock exchange. So, now you tell me which is the right option. Who are the parties in the primary market and who are the parties in the secondary market? What is the right answer? So, the right answer is the parties to a transaction in the primary market are the investors and the company, and in the secondary market it is the investors among themselves, and this option is given under option C. So, option C is the correct answer. I hope you got that right. Next, question number 6. Investors can directly buy and sell securities through the stock exchange. Is the statement true or is the statement false? So, you can just mention whether the answer is true or false. Type your answer in the chat box, question 6, and give your answer. Whether the statement investors can directly buy and sell securities through the stock exchange is true or false. The answer is, it is false. Why is it false? Because we know that the investors can never directly contact the stock exchange. The investors are first required to contact the stockbroker. Stockbroker will in turn contact the stock exchange. That is why the statement is absolutely false. Next, question 7. Marketplace for issuing fresh shares is which place? You should mention the name of the market, type your answer. Give the answer. The marketplace where we issue fresh securities is which market? Which market? It is the primary market. the market issued related with the term issue, primary market. Next. Question 8, you can again type your answer. The marketplace where trading of already issued shares takes place. Which market is that? You have to type your answer. Put question number 8 and give your answer in the chat box. What is it? It is the secondary market. I told you, associate the word secondary market with the term trading. Associate the word primary market with the word issue. Next. Price for issue of shares in the primary market fluctuates on the basis of demand and supply. Is this statement true or is this statement false? What is the right answer? So mention question 9 and give your answer whether this particular statement is true or false. Whether the shares price in the primary market fluctuates on the basis of demand and supply. The answer is that this statement is absolutely false. It is in the secondary market that the price fluctuates on the basis of demand and supply. In the primary market, we are going to determine the price either by the fixed price issue or through the book building procedure. Next. Money received in which market becomes the capital for the company? Where does the capital formation take place? Whether it is the primary market or the secondary market. Where? In which market does the money become the capital of the company? Which market? It is the primary market, because direct transaction is taking place between the investor and the company. The money that is being invested by the investors directly go to the share capital account of the company. So capital formation is taking place. So that is all about the difference between primary market and secondary market, and that is all about the classification of the financial market. Now let's move to the next question about why is there a need for us to regulate the capital market. Why should we regulate the capital market? Why is there a need for regulation? Already the setup is there. You know the market is there, you know the companies are there, you know the investors are there, you know primary market is there for issuing shares, you know secondary market is there for buying and selling. Everything is already set, everything is already ready. Then why do we need to regulate? Because wherever monetary transactions are there and we know human element is there, there are chances of certain wrongful activities, fraudulent activities, malpractices, scams, frauds to take place. So to avoid these wrongful practices, it is important that we have a strong regulatory background, we have strong regulatory authority to govern the entire market so that we can prevent all these wrongful activities from taking place within the market. Now let us see why there was a need to bring regulation. What were the wrongful activities that took place in the market, because of which the Securities and Exchange Board of India was brought into existence. So yes, in the 1980s, the development of stock market attracted a lot of investment by the individual shareholders. In the 1980s, the investors got a lot of confidence in the market. They actively started participating in the secondary market over the stock exchange, because of which it was a period of boom for the market where everything was going properly, everything was running properly, and that is when once the stock market started flourishing, everybody started seeing money, everybody started making profits. That is the time when a lot of malpractices were reported, like non-adherence to rules and regulations. Basic rules and regulations are there in any market. Those rules and regulations were being violated by the participants in the market. Price rigging. What is price rigging? Manipulation of the price. We know the price on the stock exchange is based on demand and supply mechanism. Somehow you are manipulating or controlling the demand and supply factors in the market itself. That amounts to price rigging, manipulation in the prices, controlling in the prices. That was happening. But what should actually be the scenario? The demand and supply should be natural. There should not be any control over it. What actually natural instincts are there of the investors, that should reflect as it is on the share prices. But if you control the supply or you control the demand, that is not going to reflect the true value or share price of the company. and that is what we don't want. We don't want price rigging to take place. We don't want to have any control over the demand and supply factors. Everything should be free. Only when it is freely determined, that is the actual true value of the share price. But that was not happening. Unofficial self-modulated merchant bankers. Whenever you are operating in the market as an intermediary, whether as investment advisors, as stock brokers, as merchant bankers, whatever, you are required to be regulated. You are required to be registered with authorities. But earlier, those registration requirements were not there. So people unofficially call themselves as merchant bankers. Wrongful practices were initiated. And delayed delivery issues. Earlier, we know in the 1980s, we only had physical stock exchange. We did not have physical. In 1995, we moved to online and electronic system. Before that, it was all physical. So at that point in time, there was a delay in issue. People used to buy the shares, but the shares never got delivered to them. The shares never got sent to them. They never received the physical share certificates. So all these wrongful practices were taking place within the market, because of which a lot of investors felt deceived and they were losing trust in the entire securities market. Earlier in the 1980s, it was a boom. Everybody was interested in making investment. But once people saw that this market is making money, it is a good avenue for making money, people wanted to make more money. Obviously, they had more greed, so they resorted to wrongful practices, malpractices to increase their returns in the market. When they resorted to wrongful practices, the honest investors were the ones who suffered a lot of loss. They lost the trust in the market, and that is when there was a crash in the market. But this deceiving took place because of one important case that happened in the year 1992, that is called as the Harshad Mehta case, or we call it as the Harshad Mehta scam. It was one of the biggest scam that was revealed at that given point in time. There is also a web series on this. You can go and actually watch that series to know what actually happened in this particular case. You cannot say that he was wrong or he's done something wrongful. He found the loopholes in the law and he resorted to manipulation of the share prices. Right? So what happened here is, at this point in time in the year 1992, there was this one scam which was worth 4,000 crores of rupees, because of which a lot of small investors, retail individual investors, suffered a lot of loss. They had taken debt and made an investment in the market. So they were committing suicide. They were facing huge amounts of loss. So because of this one scam, the entire market crashed when this information was put out in the public domain by the regulatory authorities. The entire market crashed, and henceforth the investors were not ready to make an investment in the market because such a huge scam has taken place. How will they get the trust back to make an investment in such a market where scam worth 4,000 crore rupees could have taken place? So once the scam was going on, nobody knew about it. Once that information was put out in the public domain, a lot of investors lost a lot of money. A lot of investors also committed suicides, and that is when people absolutely lost trust in the market, and that is when they realized that it is very important for us to protect the investors. The government realized we have to protect the investors because this is the market that is running in the public domain. Public are the responsibility of the government. We should take care of them, and that is when they realized that we have to form Securities Exchange Board of India as a statutory authority. Securities and Exchange Board of India, that is SEBI, was already formed. It was already created much earlier, 4 years before. It was established, but it was established by merely passing an administrative order. It was not formed as a statutory authority. What is a statutory authority? Any authority that has been created by the virtue of an enactment is called as a statutory authority, like ICSI. We have the ICSI Act, right? So any authority that is passed by the way of passing an act is called as a statutory authority. SEBI was created only by administrative order. They wanted to make Securities Exchange Board of India a statutory authority. That is why in the year 1992, after the scam, they passed the SEBI Act of 1992 to give statutory recognition to SEBI, to create it as a statutory authority. Why did they do that? They did it because the government had now sensed that there was an urgent requirement to regulate the smooth functioning and systematic functioning of the exchange, and thus resulted in the formation of SEBI as a statutory authority by passing the SEBI Act of 1992. So when this information came out in the public domain, the entire market crashed, everything was not operating properly, there was no smooth functioning. To take back the grip of the market, they knew that they wanted a statutory authority, and that is when they decided that it is very urgent for us to pass this act, that is the SEBI Act of 1992. But you all know the procedure of passing an act. You have to get the approval from the lower house, you have to get the approval from the upper house, Lok Sabha, Rajya Sabha. Only then it is going to be passed as an act, after the president is going to assent it and it is going to be published in the official gazette. It is a long procedure for implementing a act, for enacting a statute. It takes time. So what they did, they said that this is very urgent, so we are going to pass an ordinance. In any kind of emergency situation, we have given the power to the president to pass an ordinance, a law that will be applicable from immediate effect even without passing an act. And once the session is back, when the parliaments are in session, they can do the discussion and give a validity to that particular ordinance. So what they did, on an urgent basis, they passed an ordinance and created SEBI as an authority, and later they passed the enactment, that is the SEBI Act of 1992, and then the ordinance was repealed and the SEBI Act was brought into force for giving recognition to the Securities Exchange Board of India as a statutory authority. Okay, so before the formation of SEBI, the entire market was under the control of Controller of Capital Issues. That particular authority was responsible for managing the regulation of the capital market. But once SEBI was brought into existence as a statutory authority, this particular Controller of Capital Issues was repealed. They have now no more existence, and neither do they have any kind of powers. Now, regulation. Now the capital market is regulated under the Ministry of Finance, because ultimately it is a part of the financial market. So ultimate governance is under the Ministry of Finance. We have the Securities and Exchange Board of India as a statutory authority to look after the market directly. And you have the Reserve Bank of India, because it is a monetary transaction that is going to be involved. Somewhere Reserve Bank is also going to be involved in the capital market. Now, why is there a need for regulating the capital market again? This continuation of who is going to be responsible. The Ministry of Finance regulates the entire market under the Department of Economic Affairs. In the Department of Economic Affairs, we have a capital market division which looks after the capital market. This division is responsible for certain activities. So what is it? On the top you have Ministry of Finance. Under the Ministry of Finance you have Department of Economic Affairs. Under the Department of Economic Affairs you have one separate division, and that division is responsible for the capital market division. This capital market division is entrusted with a lot of responsibilities. That responsibility is, first one, formulating policies related to orderly growth and development of the securities market. So they are the ones who should formulate policies about what should we do for growing and developing our market. What are the things that we should do? They should do the research also of what is happening in the other places, what we can adopt to develop and grow our market. Next, protecting the interest of investors. That is the primary reason why we have brought SEBI also into existence, or why we need regulation. The ultimate objective of the government is also to protect the interest of the investors. Institutional reforms in securities market. So we have to work towards reformation. Whatever is wrongful, we have identified that there are so many defaults, so many loopholes, so many things that are not up to the mark. You have to bring reforms and change that in the upcoming markets. Building regulatory and market institutions. So you have to have regulatory authorities. You should have institutions who are going to work in the capital market. Strengthening investor protection mechanism. What mechanism, what policies, what procedures are you going to put in place to protect the investors' interest? and providing efficient legislative framework for securities market. So we need proper, written regulatory provisions for protecting the market. So all these become the responsibility of the Capital Market Division under the Ministry of Finance. Now coming to the scam again, before 1992, many factors obstructed the expansion of equity trading. The fresh capital issues were controlled through the Capital Issues Control Act, and trading practices were not transparent, and there was large amount of insider trading that was taking place. What is insider trading? Where few people are going to undertake buying and selling activities on the basis of certain information that only they have. Investors at large do not have that information. If the investors also had that information, they would also have undertaken certain transaction to make profit or to avoid the losses. But this information is only in the hand of few selected people. They are making use of that information to prevent themselves from any loss or helping them make more profits. That is not permitted in the market. If you have access to some information which only you have and the investors don't have, you cannot undertake trading activities on the basis of that information. It is prohibited. But people were undertaking insider trading activities, so we had to control insider trading activities. And recognizing the importance of increasing investor protection, several measures were enacted to improve the fairness of capital market by giving statutory recognition to the Securities and Exchange Board of India. What happened? There was no transparency. We wanted to bring transparency. We wanted to bring a lot of fairness in the market. We wanted to give statutory recognition to SEBI after the scam of 1992 took place. This was the after effect of the Harshad Mehta scam. So this is the same thing, how Securities and Exchange Board of India was brought into existence. Earlier, it was already established in the year 1988, but it was passed only through an administrative order. After 4 years, in the year 1992, when the Harshad Mehta scam took place, that is when they realized that this authority should be a statutory authority, because we have to give them a lot of powers to control these kind of scams. That is when they passed the SEBI Act of 1992 and gave this institution a statutory authority with a lot of powers to control and monitor the transactions in the capital market. Before the SEBI, I told you that the controller of capital issues was responsible for monitoring this capital market. Now, after SEBI was given recognition in the year 1992, this controller of capital issue was repealed and all the powers were moved from this authority to the Securities and Exchange Board of India. And earlier, like I told you, because the parliament was not in session and urgent requirement was there for giving recognition to SEBI, we had passed an ordinance in the month of February 1992. Then later this ordinance was converted, it was repealed, and we passed the bill and made it an enactment in the month of April 1992. So SEBI Act came into force from 4th April 1992. It was passed as an ordinance in February. In the month of April, it was passed as a SEBI Act of 1992. So once the act was brought into existence, even the ordinance was repealed. So this is a brief background of how SEBI was brought into existence. Now let's directly focus into Securities and Exchange Board of India as a regulatory authority. Okay, so there are certain powers under the sections of the Securities Contract Regulation Act, that is the SCRA, which have been now delegated to the Securities Exchange Board of India. So earlier we had the Securities Contract Regulation Act since the year 1956. At that point in time, many powers were vested with the central government because no other regulatory authority was there, no other statutory authority was there to take care of it. But in the year 1992, when we passed the SEBI Act, certain powers of the central government are now delegated to the Securities and Exchange Board of India as per the provisions of the Securities Contract Regulation Act. That means an amendment was made in the Securities Contract Regulation Act to delegate the powers of the central government to the statutory authority that was created, that is the Securities and Exchange Board of India. Because now we know SEBI SEBI is a statutory authority. It has to control the entire market. It has to monitor the entire market. It has to regulate the entire market. For that, it needs a lot of powers. So those powers were now vested with the Securities and Exchange Board of India. In addition to that, the regulatory powers of SEBI were also increased through the various SEBI Amendment Ordinance of January 1995, which was subsequently replaced by the Act of the Parliament. So over a period of time, we have realized, we set up the SEBI, Securities Exchange Board of India, statutory authority. Only when it started functioning, it identified what are the more powers that it requires to actually control the market. That is why in the year 1995, again we made an amendment to the SEBI provisions and enhanced the powers for regulating the market. Next. SEBI is under the overall control of the Ministry of Finance. We already know it has its head office situated in Mumbai. It has now become a very important constituent for the entire regulatory framework in the financial market. Therefore, SEBI now acts as a watchdog for all the capital market participants, and its main purpose is to provide an environment for the financial market enthusiasts that facilitates efficient and smooth working of the entire securities market. So now this Securities Exchange Board of India is the watchdog. It is constantly monitoring every transaction that is taking place in the market. It is monitoring every participant in the market just to see that the investors are not deceived, just to ensure that everything is happening as per the provisions of law that have been created. Though through SEBI, the regulation model which is sought to be put in place in India for regulating the capital market is in which every aspect of securities market regulation is entrusted to a single highly visible and independent organization, which is the Securities and Exchange Board of India. Now, what is the approach that they are taking for regulating the market? They are saying that we are going to have a single regulatory authority which is given statutory recognition by passing the SEBI Act. This authority is going to be an independent organization. Nobody is going to interfere with the working of the Securities and Exchange Board of India. It is highly visible because a lot of transparency is going to be maintained, and it is backed by a statute because you have the SEBI Act of 1992 which has been passed, which is going to give you the recognition of a statutory authority and which is accountable to the Parliament, which the investors can have trust. Even though SEBI is an independent organization, it is created as a statutory authority, still that authority is answerable to the Parliament, ultimately answerable to the public at large about its functions, about what it is doing, how it is operating, what are the things it is doing for regulating the market, for developing the market, how is it working towards protecting the interest of the investors. It has to answer to the Parliament so that ultimately the investors can have trust in the market. If after the scam you ask me to invest, I will be hesitant in making the investment. When the market itself is not secure, why will I put my money at risk by making an investment? But on the other hand, if SEBI says, earlier I was not there, that is why the scam took place. Now I am there to take care of you. You please put your money. We are there to safeguard your interest. So they are trying to develop the trust of the investors so that they can again active the secondary market, so that again people get trust in the market, so otherwise they can start making an investment in the market. So what are they trying to do? They are trying to develop the interest of the investors by creating a trust, saying that we are there to look after you, you please come and make an investment in the market. So by establishing the Securities and Exchange Board of India, the government is again trying to gain the trust of the investors, so again we can get back that boom in the securities market. Okay, now let's move to SEBI as a whole. We have seen the historical background, what happened, why SEBI was brought into existence as a statutory authority. Now let's go into what is the actual provision of the SEBI Act of 1992. First one, we'll focus on what are the aims and objectives. This has been provided under the preamble of the SEBI Act of 1992. It says that this act, that is the SEBI Act of 1992, is to provide for establishing the board Board means the Securities and Exchange Board of India. So what is the purpose of SEBI Act? The purpose of SEBI Act is to establish the board, that is SEBI, as a statutory authority. But with what intention they are establishing this authority? They are establishing it with three intentions. One is to protect the interest of investors in the market. Second one is to promote the development of the securities market and to regulate the securities market. And in relation to that, all other matters connected and incidental there too. They only have three objectives: protecting the interest of investors, developing the securities market, regulating the securities market. To implement these three objectives, if any other power is required, that is given by the fourth point, that for matters connected with the first 3 points, if you want any other incidental objective, you can fulfill that as well. That also becomes your responsibility. So what are they saying by the preamble? They are saying that we, through passing the SEBI Act of 1992, we are going to establish Securities Exchange Board of India. The role of that board is three things. We are setting up this board to look after three things. What are those three things? Those three things are protecting the interest of investors, promoting the development of the securities market, and regulating the securities market. Protecting the interest of investors is, the investors' money should not be lost. They are putting their hard-earned money into the market as investment. You should ensure that nothing wrong happens with them. No fraud, no scam, no malpractice takes place against them. That becomes the primary responsibility of the Securities and Exchange Board of India. Second one is development of the market. Now, you cannot be constant, right? If you want to grow, you should grow with the changing times. The way people perceived the securities market a few years back is totally different from now. The way people undertook transactions is totally different. The way people's thought process, that has completely changed over a given duration of time. The way the company's function has changed over a given duration of time. When the transactions in the market are changing, when the thought process is changing, when the method and mode of making investments are changing, even the market should change with the changing times. You should accept the developments, you should accept the changes, and with those changes, the regulatory requirement is also going to change. So you should make suitable developments in the market, you should adopt new technologies, you should go ahead with the changing times. For that, you should focus on developing the market with changing times. And last one is regulating the market. Only by focusing on the development, it is not enough. Currently, what is happening in the market is also your responsibility. So you should regulate the market by seeing that everything is happening as per the provisions of law that have been provided, that there is no wrongful practice or malpractice that is going to take place. So these are the three primary objectives of the Securities and Exchange Board of India: to protect the interest of investors, to regulate the market, and to develop the market. These are as provided in the preamble of the SEBI Act of 1992. Now, quickly, let's see. These functions are performed by SEBI. So we have identified three functions. First one is protecting the interest of investors. For protecting the interest of investors, what are the various activities that can be undertaken by the Securities and Exchange Board of India? Again, the list that we are seeing here is illustrative in nature. These are examples of certain protective functions that can be undertaken by the Securities and Exchange Board of India. They say, for protecting the interest of investors, the institute, that is the Securities and Exchange Board of India, should check for price rigging, price manipulation. They should prevent insider trading. I've already told you what is insider trading. Trading on the basis of some information which only a certain selected group of people have access to. You're not permitted to trade on that information. If you are trading, we should prevent those kind of activities in the interest of investors. So prevention of insider trading should be done. Promoting fair practices. Create awareness among investors. Now see, the market is there, regulator is there, but certain basic common sense and basic market awareness is required to be there at the investor's point of view also. The authorities can say, please beware of the investments. You should also do certain basic research work while you're going to make an investment. We say, SEBI has clearly said, please deal only with registered intermediaries. But still you are going and giving your money to unregistered intermediaries for the purpose of investment. Is it your fault or is the authority's fault? Your fault. You are not aware. So basically, investors are also required to have some certain kind of awareness, and that awareness will be given to them by the authority itself. So they should create more awareness among the investors about what should be done and what should not be done, what is right and what is wrong, and prohibit fraudulent and unfair trade practices. So they should create the laws in a way that they can prohibit the fraudulent and unfair trade practices. Coming to the second function, that is their function of developing the securities market. For that, again, certain illustrative and examples are given of how they can develop the market. First one is giving training to intermediaries. Because again, what is the main purpose of the market? Connecting the investors with the people who are in need, right? Or even helping the investors make an investment in the securities market. So you have a lot of financial intermediaries who are actually providing these services. So they should be well trained. They should know a lot. So you should give the training to those financial intermediaries. Promoting fair trading and reduction of malpractices on the stock exchange. Carry out research work, very, very important for development. If you're talking about development, you can also draw comparison with other countries. What are the other countries doing with respect to their capital market? How are they regulating? What is the situation in their market? What policy or framework have they adopted to manage a particular given situation? So do a lot of research work. Whatever is suitable in India to Indian scenarios, we can adopt those things. So only if you do a lot of research, you can come out with a lot of solutions. So that becomes the responsibility of the Securities and Exchange Board of India. Then encouraging self-regulating organizations. We want more and organizations to become self-regulated. Now, we are all asking you to study well. Okay, we tell, please make timetable, study well, you have so many days before exam, ensure you complete the syllabus. We can give you instructions, we can give you guidance, we can give you direction. But whether you are doing it or not, we cannot come into your house, sit and see whether you are studying or not studying. You should have that self-awareness that I have taken up this course, I have to clear it at any cost, and to do that I have to follow certain protocol. I should have a routine, I should study regularly, I should be consistent, I should complete my syllabus, I should understand the concept. Only if you have that thought process within yourself, you will be able to achieve each one of them. This objective, even they want the organizations to have. They want the organizations to believe that I am an organization, I am bound by certain legal principles, I have rules and regulations to follow. I will ensure that I follow each one of the rule that is applicable to me. I will be 100% compliant with every provision of law that is applicable to me. They want the organizations to be self-regulated. They want the organization for themselves to take care that we will be 100% compliant. So they want stock exchanges to become self-regulatory organizations so that SEBI does not have to constantly monitor them. SEBI is there to monitor, but if the authority themselves are so conscious about compliance, it will also help the ultimate authority, that is SEBI, to take care of the entire market. So they want to encourage every organization to become self-regulated and buy and sell mutual funds directly from asset management company or through a broker. That is specifically in relation to mutual fund. So these are certain measures that can be taken for developing the market. Coming to the last function of Securities and Exchange Board of India, that is regulating the securities market. Again, this is an illustrative list. For regulating the market, they can design guidelines and code of conduct for various intermediaries in the market. Code of conduct we have. As advocates, we have certain code of conduct of how we should wear the band, how we should wear a coat, what color we should use, how we should represent before the courts. As company secretaries, even we have code of conduct that has been issued by ICSI. So as doctors also have code of conduct that is being given by the medical council. So every profession has its own code of conduct. Similarly, Securities Exchange Board of India can issue code of conduct for the participants in the market for the purpose of regulating them. Regulation of takeover of companies. Right? Generally, takeover is the time when investors are facing certain kind of problems with respect to the pricing. So in that case, you can control the takeover of the organizations, conducting inquiries and audit of exchanges, registration of brokers, sub-brokers, merchant bankers, levying of fees, performing and exercising powers, register and regulate credit rating agencies. So in short, they should be able to regulate each and every intermediary in the market by giving them code of conduct, by giving them eligibility criteria, by giving the registration requirements, by giving the licensing requirements, by giving the net worth requirement. In short, you can control each and every participant by framing some kind of guidelines and policies for the regulation of those organizations. Next. So, SEBI has a twin task. Twin task is nothing but dual task, double role. They have to not only focus on the regulation of the market, but in addition to the regulation, they should also think about how we can improve the market, how we can develop the market in the times to come. So that is the twin role or responsibility that the Securities and Exchange Board of India has. Its regulatory measures are always meant to be subservient to the needs of the market development. Always the market is ahead of the laws. So you should always keep in mind that as the market changes, as the transactions change, as the situation changes, the regulatory provisions also should change. So you should constantly be making amendments to the laws to suit to the given situation, the market situation. So they say that the regulatory measures are generally behind what is happening in the market. So you should move ahead with the development. You should make changes as and when the market develops. Underlying those measures is the logic that rapid and healthy market development is the outcome of a well-regulated structure. Only if you have a well-regulated organization, well-regulated market, your regulator is performing very well, only then we can have a healthy and rapidly growing market. If your regulators are not efficient enough, they are not doing their job properly, definitely the market is not going to be healthy. Wrongful practices will be there. It is going to be unhealthy situation. So what we want the market to be healthy. We want it to rapidly develop. That can happen only when you have a strong foundational backbone, that is your regulatory authority being the Securities and Exchange Board of India. In this spirit, SEBI endeavors to create an effective surveillance mechanism. What is surveillance? They say when you walk into malls, when you walk into public places, or you walk into your companies, they say you are under CCTV surveillance. That means we have put cameras to monitor what you're doing in that public place. In the shops, in the malls, what you're doing, we are monitoring you constantly, we are checking on you. Same thing that Securities Exchange Board of India wants to do. It wants to constantly monitor every participant and every transaction in the market, and that is why to do that, they should have proper mechanism, technology to do so. So they themselves should create that mechanism so that they can hold that surveillance in the entire market. They want to encourage responsible and accountable autonomy on the part of all the players in the market who are expected and required to discipline themselves and observe the rules of the market. That is nothing but they want self-regulation. They want discipline in the market. They want every participant to follow the law that is applicable to them. They want compliance from every participant in the market. So this is what they want to achieve. First, they want to have the mechanisms in place so that they can do the surveillance, and second one is that they want to encourage every participant in the market to be compliant with every law that is applicable to them. This is the objective. That is what SEBI plans to achieve in the times to come. Now, coming to the regulatory framework, we saw why there was a need for regulating the market. We saw how SEBI was brought in as a regulator. We saw what are the power functions of SEBI in relation to the market. Now, let us see what are the laws that are applicable in the securities market. A number of other laws are there. Predominantly, we are talking about enactments that are applicable. Right? So first one is the SEBI Act of 1992, which is the primary legislation, because that is the act which is giving existence to SEBI as a statutory authority with three objectives that we already know: to protect the interest of investors, for developing and regulating the securities market. So that is primary, because this act gives the foundation, establishment of the regulatory authority. So that is the act that is going to become applicable. Second, we have the Securities Contract Regulation Act, which we call as the SCRA. What is the purpose of this act? Through this act, we have established stock exchanges. We are giving recognition to the stock exchange. We are giving powers to the stock exchange. We are facilitating the transaction to take place over the stock exchange. So it is a very, very important enactment in the securities market, because through this act, we have established the secondary market. Right? So this act is to regulate the transactions in securities through control over the stock exchange. The entire regulation of the stock exchange takes place through the Securities Contract Regulation Act. So that is also very, very important legislation. Moving to the third enactment, it is the Depositories Act of 1996. We all know earlier we had physical share certificates. Now I told you that we have migrated to DMAT form. Everything is in electronic form. All those requirement for regulating those DMAT shares, for giving that structure, for giving that platform, for giving that technology, you need authorities, right? And that system, entire dematerialization, rematerialization process is undertaken by depositories, and it is through this Depositories Act of 1996 that we have given existence to depositories and depository participants who can ultimately provide these DMAT services to the investors. Everything is in electronic form now. To facilitate that electronic form of trading to the investors, we need certain authorities, and those authorities and those institutions are set up through this Depositories Act of 1996. So it is to maintain and transfer ownership of DMAT shares. So anything to do with your DMAT shares, it is going to be regulated by the Depositories Act of 1996. And lastly, but the most important one, is the Companies Act of 2013. Companies Act of 2013. What does it say? It gives the code of conduct for corporate sector in relation to issue of shares, allotment of share, transfer of shares, disclosure requirements that are required to be made in a public issue. Ultimately, what are we talking about here? We are talking about raising capital by the companies in the securities market. That means, what kind of companies are there? It is a company form of organization. So again, let me take you back to the first slide where we were seeing the objective of the syllabus. Part B, we saw that securities laws are applicable to the listed companies on the stock exchange. So let me take you back to that. So whenever you talk about companies, there are various different forms of companies. You already know that. You will know basics of company law. I am going to talk only about two categories. Categories which are classified as private companies and public companies. Private companies, you all know it has minimum 2 numbers, maximum is 200, beyond which you cannot have. You have to mandatorily convert yourself into a public company. Here we are not inviting public at large to subscribe to the shares of the company. It is a closed knit group of people who are going to be a part of the company. Whereas in public company, you can raise money from public at large. You have more unlimited number of members. Any number of shareholders can be there. There is no restriction to the maximum number of members. But even in public company, there are two categories of company. One is unlisted company. Other one is listed company. When we talk about this, we are talking listing on the stock exchange. Unlisted means you are not listed on the stock exchange. Here you are listed on the stock exchange. That means this company has made an initial public offer. This company has not made an initial public offer. That means they have not collected the money from public at large. Public at large they have not invited. They have invited the money, but not from public at large. They have not issued a prospectus to the public at large for getting themselves listed on the stock exchange. Whereas here they have made an invitation to the public at large by conducting an initial public offer. Now, why am I giving you the distinction? Why am I telling you this? This is the basics. You should know that you are studying securities laws under part B of your syllabus. To which category of company will the securities laws become applicable? Securities laws are the laws which are framed by the Securities and Exchange Board of India, and these laws are applicable only and only to the listed companies, because only these companies have raised money from the public at large. What is the role of SEBI? Role of SEBI is to protect the interest of public at large, to protect the interest of investors. And where are the investors investing their money? They are investing their money in public listed companies, because that is the place where directly subscription is called for from the public at large. So that is why we say that securities laws is applicable only and only to the companies which are public listed on the stock exchange. So what is the law that is applicable to private companies and unlisted companies? They are bound by the Companies Act of 2013 in addition to their industrial law. If you are in the pharmaceutical sector, pharma laws will become applicable to you. If you are in the manufacturing sector, you have to take care of labor laws, you have to take about environmental laws, you have to take care n number of other compliance. So depending upon which sector you fall, other laws are there. But when we are talking about regulating a company form of organization, Companies Act of 2013 will become applicable. Now what about listed companies? We know securities laws are going to become applicable, but in addition to the securities laws, they also have to comply with the Companies Act of 2013. So they have dual responsibility of being compliant with not only the securities laws, but they also have to comply with the Companies Act of 2013. Why? Because still they are a public company form of organization. This public listed company is also established under the Companies Act of 2013 or any other previous company law. So that is the basic or foundation of their existence itself. So the public listed companies are required to comply with Companies Act in addition to the securities laws. But public unlisted companies and the private companies only have to comply with the company law provisions and not the securities laws. So this is the basics of the regulatory framework applicable in the securities market, where you have SEBI Act establishing the regulatory authority, you have the Securities Contract Regulation Act establishing the stock exchange and regulating the transactions on the stock exchange, you have the Depositories Act for providing that electronic platform, the DMAT facilities, and you have the Companies Act for basic governing the company form of business organization, because ultimately it is a public listed company. So they are bound to follow the Companies Act provisions. So let's quickly take a Q&A on the regulatory aspect of the syllabus in this particular chapter. So question number 11, give me the answer. Which of the following are the functions of the Securities and Exchange Board of India? First one, protecting the interest of investors. Second one, regulation of the securities market. Third one, development of the stock market. Fourth one is printing of currency notes. You can have multiple answers as well, so be careful, read every option and then give me an answer about what is the correct option for question number 11. Which of the following are functions of SEBI? So the right answer is A, protecting the interest of investors, regulation of securities market and the development of the stock market. A, B and C, all three are the right answers. It is not the responsibility of the Securities and Exchange Board of India to print currency notes. That is the responsibility of the Reserve Bank of India. So the correct option for question number 11 is A, B and C. Next, answer in the chat box question 12 and give me the right answer. SEBI intends to protect the investors against takeover, fair trade practices, insider trading or judicial orders. Read the question carefully and give me the answer. SEBI wants to protect the investors against which of these activities? Takeover, insider trading, fair trade practice or judicial orders. So takeover, has it anything to do with the investors as such? No. By managing takeover or regulating the takeover, you are protecting the companies from No fraudulent takeovers, hostile takeovers. You're protecting the company as such, but not the investors. Okay, so this is not for protecting the interest of investors as such. Fair trade practice, that is what you want for your investors, right? You don't want unfair trade practices. So that is not something that you are protecting them against. You want them to have fair trade practices. So that is not the right answer. You have insider trading. Yes, we want to protect the investors against insider trading. So C is the answer. And judicial orders. What are judicial orders? Any order or judgment that is going to be passed by a judicial or quasi-judicial authorities. But if they have passed, if an order has been passed against the investor, SEBI cannot protect them because it is an authority of a judicial authority. SEBI cannot do anything in that given scenario. So the only answer applicable in this particular question is SEBI intends to protect the investors against insider trading. Next, question 13 and the answer. Which of the following are protective functions of SEBI? For protecting the interest of investors, what are the examples? Which activity can be undertaken? Checking for price rigging, prevention of insider trading, carrying out research work, promoting fair practices. Which one of these followings are protective functions of the Securities and Exchange Board of India? Yes, checking price rigging, yes, that is for protecting the interest of investors. Prevention of insider trading, yes, that is also for protecting the interest of investors. Carrying out research work is development of the market, so this is not the right answer. Promoting fair practices also is for protecting the interest of the market. So A, B and D are for protecting the interest of investors. Only this is for development of the market, so that is not the right answer. So that is it. We come to an end of one big chunk, that is the first part of the syllabus, where we have concentrated on the financial market as a whole and its classification with the need for regulation of that particular market. In the next class, we will begin with the second part of the chapter, that is participants of the capital market. Till then, please study well and all the best for your preparations.